Good morning, everyone. This is Pro Trader Mentoring for March the 16th, 2025, Sunday. And here we go. All right, so there were a few questions. I'm going to answer them in the second part of today's session when we start talking about this chart. But let's start with where we left off last time. Sized up, that'd be nice. Okay, right, good. Okay, so we've been talking about breakouts, and you see, I think last time we got to discussing
I1R.
I1R.
Yep.
What was the session before then? Before that? Breakout
What was
test?
before that? Before that, we were talking about the tick gaps and different
Mm-hmm.
types of gaps.
Mm-hmm. Yeah, we were talking about gaps. Yeah, thanks for that. Because sort of I1R stole the session last time. Just talked about I1R. But I mean, following our process, we've been talking about breakouts and the breakout process, and then spend some time discussing different types of breakout gaps. Tick gap is one of them. Talked about breakouts, breakout gaps, and did we talk about micro gaps? I think we did.
Yes, we did. We talked about
Yeah.
micro gaps,
Mm-hmm.
body gaps, tick gaps,
Okay.
breakaway gaps,
Mm-hmm.
and breakout gap. We talked about that as well, and like a negative gap
Okay.
too.
Um, all right. So I just want to make sure that everything is covered. So
Sure.
showing you this chart first. Micro gap. Did I talk about the different types of micro gaps?
That if the bar, the third bar is a bear
Mm-hmm.
bar, for example, the
Yeah.
micro gap is weaker.
Mm-hmm.
I think so, but
Okay.
just yeah, say that right now too. But I
All
think
right.
you did.
So just in case I might have missed something, I just want to repeat that because it is important. So if you look at this chart, let me remove that other paint bar. So on this chart, we have only this microgap marker that's showing the microgaps. And looking at this chart, you will see that there are two colors. There are orange and blue. The blue ones, doesn't matter the direction, bull or bear, because there's a blue one here too. Blue ones are indicating what I call strong microgaps. And the strong microgaps are microgaps that have the two bars that are creating the microgap, the first bar in the 3-bar macro channel and the last bar in the 3-bar macro channel, both of them being strong. So we're in a bear trend, strong bear bar creates a microgap, and the other partner is also a strong bear bar. If one or both of the two bars that are creating microgap are weaker bars, like, for example, here we have a bar that's actually controlled by the bears. It's a bear bar, and so is the next one. So you see the IBS there is 42. The gap that is between these two, this microgap, is colored differently, and that's just to indicate that, okay, one or both of the components are weaker bars rather than strong bars. But the implication of this is important because, well, first of all, the gap usually gets tested. Look at this one, for example. Okay, orange, bull bar, bull bar. I mean, I'm not classifying them in three groups. They're just two groups because you can have a microgap with one of the two bars being weak, or you can have a microgap with both of the bars being weak. Okay. So as long as at least one of them is weak, this is going to be orange. And they are usually tested. Now, depending on what created that weak micro gap, it sometimes lends itself to becoming support and a good candidate for limit order trading. This is an example of it. Okay, so the bar is really big, bar 6. The distance that the market reversed the bull trend is really large. So we went from here all the way to a new low of the day. So that macro gap is important. It shows that there's an area of resistance up there. And the low of this bar, which is the functional price level of the macro gap, can be a limit order short, even though it is above a bull bar. In other situations like here, this was supposed to be a sell near the top of this trading range that's forming, but it failed. So that macro gap is important. Midpoint and low of the macro gap can be support. We never got there, but market tried to get close to it. Look at this one. So this one, we have another one of those bad macro gaps. This bar is a bear bar. The algo doesn't look at whether the first bar or the second bar is an inside bar. If you're programming, you can actually look for that as well. It just looks at macro gaps. But both of them are inside bars. However, it gets follow through and then a test there. You see all of these tails. Somebody bought there and they scalped out, bought there and scalped out. So it led to at least one little scalp. So that is also important. And if you want to study this, it's a very good subject for honing your skills with respect to limit order trading, how to use macro gaps to trade with limit orders. The opposite also happens. Like here is a tiny, tiny macro gap. Look at the low and the high of that bar. Low is 62 even here. High is 62 even. I call this a zero height macro gap. Basically, these two tails are touching, but they are not overlapping. If you look at, I think there's an option for it. Oh, okay. We'll just read the first one. Zero height gap, show, so true. If I turn this into false, that marker there will disappear. But you can detect for them. And it's important to recognize them in the first place, that even though it looks like there are no macro gaps, but because they are not touching, there is actually a gap there. So it is equal to something like this. So you have a swing point and a pullback, and then the market goes higher. So that swing point is the breakout point now. And then it comes down with one or two legs to test it. And then there's another bounce. Okay. As long as there is no overlap, the test is a perfect test. Okay. So perfect breakout test. Now, all of this, so this is about zero height macro gap. All of this is happening on a lower time frame chart that is resulting in that zero height micro gap on your trading chart, the chart that you're looking at. Okay, so it's important to recognize them because they really exist. So if you look at the lower time frame chart of this chart, you will see that. I mean, you can also see it here. We had a reversal. Every reversal is a breakout and pullback. Okay, so it's the opposite image to this. The prior leg was going up, you have a reversal and a pullback that creates that swing point. And then the market falls through it and pulls back to test it. So there's a big breakout going down with the test. Sorry about that. Test and then that. And that creates a zero height macro gap. So it's important to see them. Now look at what happened next. So we have an outside up bar, broke through this. Now it is support. Tail of this bar is testing the breakout point, which is that macro gap and the high of bar 43.
But how would you not know that's just not testing the EMA?
Because EMA does not exist. All right.
Okay.
EMA is not a market feature. EMA is a man-made tool to estimate the value area for a chart. Market doesn't recognize EMA. Market recognizes price action. So you can actually, let's see if we have this.
But we do see the market respecting EMAs.
Market respects many EMAs. You're just looking at one of them.
Right.
What about all the rest? If I put a faster and a slower moving average on this chart, you will see that market is testing them too.
Agreed.
But those are, yeah. Sorry, say again?
Yeah, I agree.
Yeah, but EMA is completely man-made. I mean, like obviously it is man-made, but I mean, it's not a function of market behavior. EMA is just something we put on the chart to try to explain it. Just like all the other indicators that we put on charts to try to explain it. You should be able to trade without an EMA on your charts. I mean, give it a try. You can completely trade the market without an EMA. So this is, if I disable this, do you think that it's untradeable now, this chart?
Not at all.
No.
We could trade that, no problem.
Yeah, I agree too. I mean, it's completely tradable. So EMA is just an indicator to hopefully make it a bit easier to make decisions faster. And it is also, like any indicator, you can play or form some tricks around it. And using those tricks, generate some more trades easier. That's all that there is to it. And you know about the tricks. And I try to mark them on the end of the day charts myself too. Breakout above the moving average. Okay, so always in long. But market was always in long, even without the bull bars appearing down here. Even without the moving average being there. So, yeah. You can say it's testing the moving average, but if the moving average is not there, it's easier to see what the market is testing. Let me see if we can find. Oh, and then the other thing about the micro gaps is that if you have two of them back to back, here's one and followed by next one, both of them are strong. The area of support and resistance that they provide is a accumulation of both of them. So they have this cumulative effect. The gaps get added together. So now the higher one is more important than the lower one. You see the market's paying attention to this one rather than this one.
Mr. Ashari?
Yeah.
What about the example to the right of the chart, right next to the one that you were showing for the accumulative? Yeah, so do you see 57 and 63?
Yeah.
So there's two micro gaps there too, but do they kind of get added up together too, or does it have to
No.
be back?
Yeah, they have to be immediately adjacent to one another.
Okay.
Like these two. Like these two. But if there are bars between them, like for example here, no, this is on its own and the other one is on its own.
Okay.
Yeah. The other thing that's important about macro gaps, you can actually use them in that manner. is to look at, how many of them are you getting inside of either a simple or a complex leg. Like for example, here is a complex leg because it has pullbacks. Usually you get 3 or 4, and then there is a correction. There is 1, so these two are adjacent, so just 1 macro gap. Here is 2, here is 3, here is 4, and these two, 4. Probably not going to go much higher. So that's the same energy idea that we base wedge and parabolic wedge recognition off of. It's just that in case of wedges and parabolic wedges, we are looking at pullbacks to identify price legs. But you can also look at gaps because breakouts produce gaps. So by looking at the number of gaps that are present in a leg, you're effectively saying the same thing. There are cases, however, like this day, that we're probably going to get more because of the nature of the price action small pullback bear trend. But even in these cases, you can sometimes, or most of the time, look at the macro gaps and decide that, okay, it's overextended. I'm not going to be short anymore, at least, and see what happens. So for example, here we have a trading range market's breaking out of. There's one macro gap there. Let me get my pointer back. So there's one macro gap there. There's one here. These two added together. There's 3. Probably not going to go lower all that much. You see, we're correcting. And then another 1 and 2. And then there's a reversal. So if you don't really include this as reaction to this wedge, which actually it was, then we have 1, 2, 3, 4, and 5. So this is really, really overextended at that point. And you see, completely reversed. The final thing I wanted to say about macro gaps is, if I find an example, that'd be nice, is how they, react to breakouts of trading ranges. Let me draw it up. It's easier, faster. So for example, you have a trading range that's kind of well defined. So you have a trading range here, has a top, has a bottom, and then you have, a price leg that's bouncing off of the low and moving up. And there's a bar here, and suddenly you get this big breakout bar and a test. So at that point, there's a macro gap there. Come on. All right. So there's a macro gap here in these two bars, this area, and that macro gap is now sort of straddling the top of the trading range, the resistance area. So macro gap straddling. Is it double D? I'm not sure the spelling is correct.
Yes, that's correct.
Yeah, thanks. Resistance of trading range. So if you get that, that is one of those signs of strength. And it usually leads to a better test of the top of the range, or more reliable follow through continuation in that direction. We can sort of see it here, but it's not the best example. So you can say that we had the leg down, we had the leg up, we had the leg down, we had the leg up. So there is a trading range here, and we are breaking out of, and there is a macro gap as the breakout is forming, this macro gap. That increases the probability for the breakout to succeed if it remains open. What about here? Not really, we don't have that there. it's just important to pay attention to them because when they happen, they're not all that common, but when they happen, it's one of those signs of strength. What about this one? No, don't have it here. All right, so any questions about this?
Yeah, Mr. Ashley, could you go to the whiteboard, please?
Mm-hmm.
So above when you were drawing the micro gaps, so a micro gap can be tested twice basically as well, and it can have like a double top to the micro gap or a double bottom to the micro gap too, right? It's not just like one time and it gets used up.
Yeah, of course. I mean, you can have that. The thing that I was trying to explain here was a zero height macro gap, which is basically a single test because there are only 3 bars, right? For a double top or a double bottom test, you probably need 4 bars. But a zero height macro gap, the minimum number of components in it is just 3 bars.
Yeah, the
When
question I'm
when
asking
you
is more
say
like if the micro gap is just if it gets tested once and then it's used up, because that's kind of like a um, ignorance problem that I've had. That let's say there's a micro gap and I'm like, okay, I'm buying with a limit order there, and then if it gets the tail of the bar goes to the bull micro gap, I'm like, okay, it's already used up now. So
Mhm.
um, I
Like
don't
this one.
know if it can get tested again. Yeah, that could be an example, but sometimes it's even, let's say a 46 would just go there and then
Mhm.
we would reverse back up, you know?
Yeah,
So,
because it's an area. It's not really, it's like everything, every bar. So for a bar, you want to buy in the lower part of the bar, in the buy zone of the bar. Same with macro gap. You want to buy in the lower part of the macro gap rather than the top part. You can buy in the top part, but in those cases, you're usually basing the trade off something else. Like here, for example, it is 3 bars up. Last bar is a strong bull bar. You can buy the low of 45. But sometimes you also have to scale in. So
but it's not like it gets used up. That's another question I'm kind of asking. Is
no, if it
it?
is closed, it's tested fully and
Okay.
closed. Yeah.
So like if it's fully closed, then it's tested. But if it kind of goes down a little bit in the top
Yeah.
range of it and the bottom range is still there, it
Hmm.
could also
Yeah,
be
it's like
active as well.
exactly. It's like any gap, right? It's a breakout gap. So
Okay.
this used to be a big breakout gap, all of it. Market came back up, overlaps the last bar, so the gap is closed. But as it is approaching the top, the gap is still open. It's just being reduced and reduced and reduced.
That makes sense.
Okay. All right. Good.
Hello, Mr. Achari. Sorry, I also had one question related to the same
Mm-hmm.
discussion that we are having.
Mm-hmm.
So when we say we are testing the gap, does it have to be a body close behind the gap to say that we have successfully tested it, or even if the tail goes beyond the gap starting point, then also we say that it successfully tested it? Like, is there any distinction between these two types of tests in terms of strength of the gap and follow through?
You can form strategies based on, different requirements for a test, for example. But I personally just require a tail. Like to me, this gap is closed, although there are no
Okay.
bodies here yet. But you can argue that it was open up to this point, and then finally we have a complete overlap there. But for all trading purposes, as long as the gap is not getting a tail into it, I consider it open. If there is a tail there and tested, it's been tested.
Got it. Thanks.
Yeah,
Thanks, Mr. Achari.
sure, no problem.
Ali,
Jason.
yeah, quick question.
Mm-hmm.
Just so I can think through this. So you're saying the weaker gaps get tested, and your premise behind that would be you're sort of in a trading range because you've got opposite, you may have an opposite bar creating the gap.
Mm-hmm.
Stronger gaps, the blue ones, would they would demonstrate more of a trending environment, so they wouldn't
Correct.
necessarily get tested. So I did a back of the napkin study several months ago in this, and there's several trades if you're, so in a small pullback trend or something, there's several trades that you could just put limit orders in to test these, two or three a day. I mean,
Yeah.
it looks like a good system. I didn't really pursue it because I wasn't really, I just, I found it interesting and I wanted to go back.
Yeah,
So
hear you.
to perform a test for this, I mean, to go back and do a study, would you propose looking at the weaker ones? And in this case, they're kind of the orangish color. But is there anything specifically like just a weak trend, or if I'm looking at the fact that they're going back and testing them, what would you? I mean, is there? I don't know. I just the thought process. I'm just you got my brain thinking here, and I'm just
Hmm.
thinking how to perform a structured test for a structured study.
Everything has the context component or element in it. So whenever there is a weak micro gap, you also have to look at what is producing it, or what are the conditions leading to the production of that micro gap. On this chart, for instance, bar 27 right here, you can argue that this was the second time that really the environment tried to change, because this was the first one. This one immediately failed, but this is remaining open, it's getting follow through. So maybe at this point, the market's always in long. So I mean, the context is important, and the type of the day is also part of that context. Let's look at, for example, I mean, this is not even that, but half of the day was like that. Days that have very intense two-sided trading, very tight trading ranges. Tight, I don't mean like the points, the distances are small. It's just a lot of back and forth, and gaps constantly getting tested and closed. In here, we have two gaps of two different types, bull and bear, and weak and strong, and both of them are closed and tested. So you have to factor in context into anything that you're testing. But beyond that, I mean, it's a very simple concept, and it's just a setup for a trade. The important thing to recognize with respect to microgaps is the cumulative feature of adjacent ones. So if you see this, especially in a trading range, the first one is not all that important as the second one is. Actually, should have said it the other way. The second one is not as important as the first one is, because this is the one that is going to provide the resistance in this case. And you see market tests there up to the top of that gap. Not really. I mean, you have to. I mean, I mentioned all the points. One was this, the type of gap, strong or weak, and then paying attention to what the gap is doing to a trading range. Here's another example. Leg in a trading range. Okay, so here's the top, here's the bottom. This gap is straddling the top of the trading range. That's very important. So more likely to get follow through.
Ali,
Yeah.
yet in that bar 30, it's painted yellow as a weak microcap. Why would that not be blue?
Well, because of this bar. This is the second element, the third bar in the simple bull leg that is creating the microgap. So the microgap is a function of the first and the last bar in a 3-bar sequence. First bar is good.
Right, but I can see kind of from a logical standpoint that if you have a 3-bar microgap, and let's say, okay, bar 1 is weak, there would be sellers above that bar.
Okay.
And so if you could then get the breakout, there's going to be more pressure to want to get back down to the top of that bar. Whereas if that bar 1 was a weak bull bar, like
Yeah.
say 29 was weak, there would be less, I'm sorry, if it's a strong bull bar, the first bar,
Mhm.
there are going to be less sellers above, whereas if it's weak, there's going to be more sellers above. So it seems
Right.
to me like the bar one is going to be more of a determining factor
Mhm.
than the bar three. Is that a logical way to be thinking about it? Is that the correct way to be thinking about it?
I agree with you, but the difficulty then is that in a bear trend, for instance, you're going to get bull micro gaps that have the last component as a weak component, and they get tested and closed. Okay, but I hear you. I mean that's a good way of thinking about them. That the buy was low probability, didn't have the merit of producing a big and huge breakout, but it did. So now it's a surprise. So the first bar in the three bar sequence is more important than the last bar. But also, you can take any concept and produce algorithms from it and make it very, very detailed. My idea with respect to algorithm development is the minimum vector analysis approach. Like, what's the least number of information items that can give us a decision or determination? And I leave the rest to myself. Like, for example, if you think about this leg here, which has a orange micro gap, take it from this situation. This is at the bottom of a wedge spike and bear channel, nested wedge with multiple, attempts to go down, all failing. Take it from this context and move it up there and put it at the top of this leg. The meaning completely changes. So in that case, how would you design that algorithm? So here, bar one is strong. So it's fair to say the macro gap should be blue. But then the same setup further down, uh, as a late leg in a bull trend, we'll be getting a blue macro gap, and then it wouldn't be correct.
So Ali, this shows the same thing like your overlap paint bar. Bar 30 has no overlap. You can look at a large gap like this.
Yeah.
It's essentially a breakout bar, and you use that system that you use that, the paint bar for that. You can look at the overlap paint bar for that, or you can just look at the gap. You're going above essentially a trading range. So you know that, you could use all three of those to find the same thing, which is you've got strength.
There's always more than one information element in making trading decisions. Yes, I agree.
Right. Okay. Got it.
Hey, Mr. Ash, are you?
Yeah.
Jason just inspired this question for me.
Okay.
So you can have a micro gap in a leg in the trading range, right? The leg can be a leg in
Absolutely.
the
Look
trading
at
range.
these ones. Yeah.
Exactly, yeah. Even though
Yeah.
it's a trading factor, you can still have it in a leg in the trading range.
Yeah. Legs in trading ranges are still price legs, and like every movement can have all of the components that are present in any price leg, including micro gaps. The only thing that is different usually about trading legs in trading ranges is that there's usually something wrong with all of them. For example, here it's a reversal up, but starts from a bear body at least, doji bar. This shouldn't have reversed it by this much, but it does because it's in the trading range. Here, the reversal point is formed by a bear bar, this bar 11, and then there's an inside bar, so the low doesn't go below the low of the prior bar. So really, the swing point is controlled by a bear bar. That's bad for the bull case, but you have 3 bars up. And then this reversal down starts from a bull bar. And these inside bars do not count because the highest point is the swing point. So this shouldn't lead to that, but it does. So those are features of legs in trading ranges. but they can produce micro gaps, of course. Every leg in a trading range is usually a kind of a climax. And because of that nature, market is looking for top and bottom and ultimately to break out of that range. So it's really testing up, vacuuming up, getting vacuumed down. And legs in trading ranges as a result are usually climaxes up and down. So the fast moves that get to support and resistance and then reverse. And they don't need much to reverse. They can reverse from sort of any bar. They don't need those clear, good signal bar, good follow through bar, that sequence. They just reverse abruptly. All right, so let's move on to talk about breakout mode, which is super interesting. Okay. Understanding this is one of those major skills in trading. So pay attention, this is really important. So breakout mode means the market can be in a situation where a new breakout is expected. Simple as that. Okay. Situations where a new breakout is expected. Now, this usually when I ask the question, okay, what do you think? People say a triangle or a trading range, and those are correct. But that's not the entire thing. So those are obviously two of the situations where, a breakout is expected because the market's not, for example, in the case of a trading range, it cannot range compress beyond nothing. You are at the tip of a triangle with multiple legs. At this point, the range is so small that market has to break out. So triangle is one of the breakout mode BOM situations. But there is a lot more. So let's look at the different types. Well, we have
End of a structure.
now I'm just trying to organize it correctly for you guys. So the first one, I think the best one is to think of as opposite setup. Okay, so there's an opposite setup with near equal strength. So for example, you have the bull bar followed by an equal bear bar. So a reason to buy in that direction, a reason to sell in that direction, market's looking for direction. So there are two opposing setups with almost equal strength. Then there's the first one I mentioned, which is range compression. Okay, so let's move this down to here. Okay, like a triangle, the range gets to almost zero, and it is much smaller than the average range of bars that have been seeing on the chart. So the market is in breakout mode. It has to get out of that range to be able to continue doing what it has been doing. Triangles are the best example. But triangles are not the only example. For example, here, we had this on this chart. We have a very big bear trend or bear breakout. And the size of the breakout is much bigger than the trading range it is producing. This is really not a triangle. I mean, it compressed the range eventually to these bars, but it is more of a, rectangular shaped trading range. But the range is, although it is quite big, let's see, so from here to here, or to these highs on average. So it's about 50 points, 46 points. Still small compared to this. So it has to get out of this situation to be able to continue in the direction of that energy entering the trading range. But triangle is a good example anyway. And the third one is when you have a pattern that's almost complete. So completed pattern or structure. And this is like, for example, a wedge is complete. Now the market is waiting for a response to it. So for example, you have a wedge here. It looks complete. Let's say you don't have a signal bar yet. So the last bar is the bull bar. What looks like a complete wedge. At that point, even though there is still no signal bar for the bears to start selling or for the bulls to get out, the mere fact that this pattern or structure is approaching its point of maturity, it's complete, means the market is already in breakout mode. Okay. The absolute minimum is this though. When the market is in breakout mode, price action has two consequent opposite spikes. Spike going up, spike going down. That's the minimum. Then following this, the more complex version is when you have a reason for the bulls to buy, a reason for the bears to sell based on the two test rule. So for example, in a tight trading range where you have a double top followed by a double bottom, so DT, DB in a tight trading range, that also results in breakout mode. Because both sides have something to justify trading in their direction. Now let's take a look at a bit more details on this, because breakout mode is really important, and recognizing it gives you a lot of a lot of advantages in taking profits properly, in being able to anticipate what's going to happen next. So this is one of those things that you have to do some homeworks on as well. Let me get rid of that macro gap thing. All right, let's use this chart as an example. So here we have a trading range with a double top and a potential double bottom. First bottom, down, second bottom. So at this point on bar 8 or 9, the market is already in a breakout mode situation. There's a reason to buy. Okay, new high of the day, big reversal from a low of the day, and a double bottom. And bears look at this and say, well, there's a double top, price is still below the moving average, and there is bear energy. So first leg down, low 2, second leg down. So at this point, market is in breakout mode. We get the reversal down, so 9 becomes resistance tested there. But then you get the range compression version as well. So we have one leg up, 2 legs up, 3 legs up, and at least 2 legs down. 1 leg down, 2 legs down in a trading range. That's reducing its range, it's compressing into a single bar. So at this point, either on 17 or 18, market is in breakout mode again. Maybe as early as 16 even, because if you don't look at the rest of the chart, it could be this bar. The only problem is, in this case, the second leg is implied. It's not visible, because the move from 12 to 14 is rather strong. It is 1, 2, 3, 4, 5 trending lows. So that's not going to immediately reverse. It should go sideways and then reverse. And there is an element of that sideways between 15 and 16 because 16 tested below 15 and 14, and then there is a tail on top. The only problem on this chart is that probably the leg up occurred first, and then the market is testing these lows because this chart is static. We don't see what actually transpired here to create 16. But just because 16 is a bear bar with the tail on top, it means the tail formed first and the close formed later. Therefore, this test at support that should produce a second leg up based on the 5-bar bull microchannel, at least one more bar sideways to up, right? That's the minimum expectation. That has not happened yet. Therefore, probably this is a point that is early in that breakout mode estimation, but it's getting close. So now we have that. And in the process of formation of this bar, which was the minimum expectation after 5-bar bull microchannel, now bears have 1, 2, 3, 4 trending highs. They're controlling the market for many bars. So it's not probably going to go up all that much. Now there is very likely the market is in breakout mode at this situation. And then 18 might be the trend resumption signal, which later become. But whenever there are reasons for both sides to take a trade, the market is in breakout mode. Let's look at some more examples. So here's a general question for you. Do you think that it's fair to say that on every bar, the market is in breakout mode?
Yes.
It's making higher lows.
Mm-hmm.
Yeah, on every bar, I think there is
Mm-hmm.
the reason. Because on every bar, there's a reason to buy and a reason to sell. So,
yeah,
on a philosophical level, that could be true.
Every bar is a signal bar.
Yeah.
And because every bar is a signal bar for doing something, the market is actually in breakout mode on the close of every single bar. It's just that everything has a scale, right? A scale of probabilities. And, when you're calling something, you're giving it a name like breakout mode. Usually in that exercise, we are excluding some of the percentages in that range of possibilities. Okay, but it does not mean that they don't exist. They actually do exist. Let me show you some of them here. So a big outside down bar in a very, very tight parabolic wedge. Basically no selling pressure up to this point. You can say we had this, that was selling pressure. We had that bar or this bar, there were selling pressures. But really nothing much going on for the bears here. And then we suddenly have this bar. So very large opposite bar. Market is in breakout mode at the close of the bar. And potentially there is a buy here because this is the first attempt principle. Okay. Because the bar is such a big surprise, on 45, which is a high one, it's a bad high one, the market is in breakout mode again because bulls want to take it up. Bears see this as a surprise, getting a second leg down. So there is a point here to make a decision whether we are going to go up or going down. And you see what happened next. 2 bars sideways, so inside, inside. Actually, this is I, because 45 is also an inside bar. Inside, inside, inside. So what is all of this? Triangle on a faster chart, right? 3 inside bars, range compressing into a doji. All of this is equal to this. So on a faster chart, you're going to see something that looks like that here. And then bear trend resumption down. At least one small leg was expected. But look at how it is starting. It's starting with this bar, breaking out of the triangle. But the bar is not looking great. It's not a good, breakout bar. It's closing above the low of the prior bar, So it is breakout pullback on the same bar, but the bar is small and it is right above support. So breakout mode again, gets the breakout. Breakout fails to close below the low of the power bar, becomes basically a bull controlled bar, IBS 51. So still in breakout mode because bears are discouraged here, disappointed from selling. And bulls look at this and it's not good for them for buying because it went quite a lot lower and then reversed up and the body is still bearish. So market is looking for a decision, breakout mode. We have another inside bar here, 50, which is a strong bull bar, but forcing you to buy near the top of this trading range. So breakout mode again. And then another inside bar, so II. So another triangle. This is interesting. Look at how it looks like. So if we summarize all of that, we have a bear leg followed by a triangle, and a breakout, and another triangle here. That's how it is really. All right, so double triangles. All right. So market is in breakout mode on 51. And here's the breakout and follow through. But it is forcing you to buy near that bull trap near the top of the range. So on 53, market is also in breakout mode. And it is on breakout mode on 52 because this needs follow through. Just like the bear bar, no follow through sideways, bull bar, if no follow through sideways or reversal. So it is in breakout mode here. Gets follow through. Now you're near the top of the range. Breakout on 54. Big, small, big usually corrects. Breakout above the top of the range usually needs follow through. And you see the reversal attempt, tail of this bar. And then strong close above. Okay, now we have big, small, big plus follow through. What does that tell you?
It's support now, 54 high support.
Yeah, probably 54 high support. And higher probability for a pullback because if you look at all of these legs coming up to here, the trend legs, they have 4 or 5 bars. 1, 2, 3, 4, 5. Pullback. 1, 2, 3, 4. Breakout and pullback on the same bar. So we are approaching that tempo limit as well. So again, breakout mode situation bar 55. It gets a bull breakout. Now that interesting point that the market has to test, that crown is taken from the head of 54 and put on the head of 55. Okay, because now this is the bar that broke the tempo. Therefore, it gets that test initiative, take it over from 54, which was the BSP that had to be tested. And you see the market tests this bar, gets close here. I mean, this one is a perfect test of the high of the bar, high of this bar. And this is the correct test that overlaps. All right, so what about 56? Count 1, 2, 3, 4, 5. We're getting to that limit of 5 or 6, which most, even long trading range, long macro channels or simple legs stop and then there's a pullback. So again, breakout mode on that bar. 57. Now it is one more bar added. So 3, 4, 5, 6. That's really on that limit of 6 bars. So it should correct here, should reverse here. Every time that there is something that looks complete, there are 2 arguments. Pullback, which is higher probability, or continuation further in that direction, which is a low probability event. But because of those 2 choices, market is at breakout mode again. So 58 does the higher probability thing, outside down bar, bad sell signal bar, outside bar, needs follow through. So again, it is in breakout mode here, looking for direction up or down. Now we have an opposite bar, excuse me. two opposing bars, excuse me. High 1 after a bull breakout, but leg 3 in a, or big leg 2, you know, however you decide on the leg count. So it needs follow through. Therefore, at this point, market is in breakout mode again. Inside bar, now we have two bars going down, but the problem is 60 and 59 are both at the same price. So if this is the second entry short, it should be at a lower price or at a much, much higher price, but not at the same price. So it's really reducing the risk because it is the second entry short, but it is not giving the bears a more disadvantageous price compared to the ones who took the higher risk trade on the first reversal down. So this is probably a bear trap. Therefore, market is in breakout mode. Another inside bar, so now it's becoming a triangle, II, breakout mode situation. This bar probably failed breakout, and now potentially a high 2. This high 1 didn't trigger. This is a potential implied high 2, but because the first one didn't trigger, it's also the first reversal up. If it gets triggered, you can say this was the high 1. Gets triggered, the bar is mostly overlapping. Next bar gets follow through near the top of the trading range. But you know, the close is not above the high. So bulls need more. If bulls need more, what does that mean? Potential failure point. Yeah, so again, breakout mode. 66 double top at a higher price compared to the first one. And this is still looks to be controlling the market. So low probability sell, which means market is again in breakout mode. This needs follow through. Doesn't get follow through. Look at the urgency here, tick gap and everything. So this is probably potentially going to provide support later on. So is the tail of bar 70 testing this and that earlier sells that all fail, or is it testing the moving average? What do you think? And the high of this bar. So I think those things are more important than the moving average. You can take the moving average and put it aside and still see all of these things and put a limit order here to buy. But it just so happens that that limit order coincides with where the EMA 20 is. So that EMA is deceiving. It's taking your attention away from, you know, what is actually controlling the market. Anyway, big bar down. I think it says, yeah, it is an outside down bar. So this needs follow through, breakout mode again, so on and so on. So we can sort of analyze all charts and look at the both sides of the coin. And on every bar, there is an argument for doing something and not doing something. Therefore, on every bar, the market is in breakout mode.
So, Mr. Afshari, for breakout mode, are you implying that we don't know the immediate the immediate response, basically? There's an event and now the immediate high probability response. We don't know that? That's why it's breakout mode?
It's just recognizing that there are two sides to trading and the other side has arguments. And you have, as a trader, you have to see the other side's arguments and respect them. But if the market is overall bullish, for example, all of those arguments will fail. And the market will continue to go up despite, you know, the other side having those arguments. Okay. So momentum and context, right? The context is bullish, yeah, and you see evidence of momentum. Breakout mode situations, like every bar, is going to result in continuation in the direction of the context, especially when momentum is present. But if momentum is not present and the context is different, then making decisions based on breakout mode analysis is very powerful because you see a bull bar, you can sell it. You see a bear bar, you can buy it. The enabler is understanding the role that that bar plays in that immediate context on the chart, to and you know, also recognizing that on certain bars the reversal probability, the argument for reversal is actually stronger than the argument for continuation, although the bar is a trend bar. And what gives you that possibility is, you know, looking at every bar from this point of view, that on every bar the market is in breakout mode, and the direction can be opposite of what seems to be possible. Right?
Yeah, that's how I was thinking about it in terms of the dominant control, like which one is the dominant move, the dominant feature.
Yeah.
And then when there is a breakout mode, you would kind of put it in towards the context or the momentum, as you said.
Yeah.
You know, even if it's an event response that just happened, a new event, you would kind of look at what just happened that's controlling the chart more, and you would give more percentage to the probabilities of that side. But when
Correct.
you're saying it's like breakout mode on the way you just explained, to me that kind of just implied that when there is a breakout mode, it's just that there's an event that just happened, and the immediate high probability response is not clear. Is that incorrect? Is that an incorrect understanding?
I'm not sure I got it.
So I'm saying that when you just the example that you were showing right now, that on every bar there's a potential breakout mode, you know, and you're going bar by bar.
Yeah.
To me, I was kind of understanding it that okay, there's a context, that there's the momentum before that you were explaining right now, that there's a bigger momentum, and when there is a breakout mode on every bar, like you were explaining, the way I was looking at it was that there would be more percentages for the probability of that prior big move.
Yeah.
Okay. But when you were kind of going bar by bar and saying, okay, there's a breakout mode here for the immediate response, is that implying that the immediate response is the immediate high probability response is not clear because it's a breakout mode right now?
No, it doesn't mean breakout mode doesn't mean things are unclear. It just means that there's a probability for the market to do the opposite thing, and there's a reason for it. That's really all breakout mode is all about. Like, for example, on this section of the chart, the biggest influence is coming from this huge sell-off the prior. So a leg down is more expected than a leg up. So all of these reversals up should fail. All right, so context is actually telling you that there is higher probability to one side of the market, but there are certain arguments on every single leg here that is contrary to that direction, to the bearish direction.
And that's for the immediate response then, because there's an immediate event, and then for the immediate response, it's kind of might be contrary to the bigger context.
Correct. And that's always the case. I mean, charts are fractal, so the bigger events ultimately have that lasting effect. Like, for example, we had been in a bear trend for several weeks now, but in this bear trend we have had tremendous rallies. Look at this one. Look at this one, right? But that higher time frame context is controlling the market, really. So all of the rallies are going to find resistance and reverse. But while they're in progress, their own dynamics are controlling the market for that immediate future, which is the next bar or two. This is one of the challenges of trading. I mean, a lot of traders find it difficult to be able to think multidimensionally, because part of the brain has to constantly view that higher time frame, what's going on the, for example, daily and weekly charts, even 45-minute chart. And some part of the brain has to manage the trade on the 5-minute chart and also drive expectations and information from that higher time frame piece. That's difficult, until it becomes, it's a skill set and becomes natural, which you don't really actively think, but you just know what's going on. This is what's going on. And breakout mode, just like everything, is fractal. So we have two big legs up here and here. At this point, we are in breakout mode based on a higher time frame context. It's a double top, it's a big double top across 2 days in a bear trend. So double top bear flag with a very strong first leg down. So more likely we're going to go down. Okay, but for the market to go down after this much buying, you need time. You need either something like this, very strong momentum. This was low probability after this sort of a tight bull leg. You either need this or you need time. You need time to put the market into a two-sided trading environment, a trading range, and a very clear breakout mode situation again. This is also, trading ranges are variations of triangles. So I said range compression here, and I didn't wrote trading ranges because really trading ranges is a subcomponent of complete structures. So TRs are here. And when trading range is complete, you usually have 5 legs. For example, 3 up, 2 down, or 3 down, 2 up. But 5 legs. So that is when the market is in breakout mode and the trading range is complete or almost complete. Now, if you look at that chart, you see 3 legs down, 1, 2, and 3, and you see 2 legs up. At least either this or this and that. So somewhere here, this trading range is approaching the point that it should stop reversing and start breaking out again. So market is in breakout mode. All right, but before this trading range was forming, the mere fact that we are not going above that high and we have had a two-legged correction in a bear trend on a hard time frame, it means the market is in breakout mode and it has to decide. But that decision is happening on 45-minute and daily charts rather than the 5-minute chart. 5-minute chart is going to produce something that is necessary for that thing to happen. Sometimes it is in this form, sometimes it is in this form. But both are going to lead in the same kind of result, which means bear trend resuming again. Now, if you look at some more general things, because this was extreme, thinking about every bar being in a breakout mode situation, but I wanted to point out that it, in fact, is the case. And if you, do the practice, if you look at every bar from both sides of the market, what arguments each side has, it's going to give you like superpowers because you wouldn't take anything for granted. Oh, the market's going up, so I have to buy. The other side also has an argument. What's that argument? It's very important to see the picture from their point of view as well, because it gives you ideas for trading that are beyond what beginners understand. For example, this bar here is breaking above a double top, so it is breaking out of a trading range, and it needs follow through, which means it might not get follow through. Especially the last bar was this bar, it was a bad bar, but it gets good follow through. So now high and close of that bar is support, and look where the market's testing. So one of the, if you watch a professional trader trade, one of the things that's going to strike you is 2 things, actually, not one thing, 2 things. One is how little drawdowns are in their trading. because most of the trading is done with limit orders in this manner. So there's a limit order there. How much drawdown did that produce? Almost nothing. And that is beyond, what beginners can usually do, because beginners usually buy closes and they buy breakouts. And you know what happens after. This is rare. Usually this is what happens. You buy a breakout, there's a deep pullback. Okay, you buy a breakout sideways for half an hour, 5 or 6 bars. So
question, Ali?
Pardon me?
Question?
Yeah, just give me like 30 seconds to finish this.
Okay, sorry.
So one of the very striking things when you look at professional trading is that you see them taking trades with very minimal drawdown, because they understand the breakout mode situation dynamics, that there's something for the other side, and they usually wait for the other side to get trapped, and then they buy with them or sell with them. That is usually a surprise. The other surprise is the exact opposite. What is the tolerance for taking drawdowns, which is the complete opposite of the first one? Like, for example, market is going down, they're buying. And then you see, a position size that's increasing, and with it, the drawdown in the account is increasing. But in the face of that, they still buy. And why do they do that? Because they understand the probabilities for example, this to go down is actually quite low. So all of the trading falls into an exercise of expressing somebody's opinion based on probabilities. And the drawdown or risk is just not a factor in that kind of trading. Understanding breakout mode gives you that possibility, that gets you closer to a very good and clean execution. Sorry, go ahead. You had a question?
Yes, thanks, Ali. So I've actually always been curious why Al coined the term breakout mode instead of reversal mode or no breakout mode, which seems more suitable. Which, breakout mode, it seems like we should be waiting for a breakout, which is actually the opposite of what we should think about. Do you know
really,
why?
No. Yeah. No, because breakout mode means a response is due, and that response could be in either direction. Don't forget that reversal is also a breakout, right? This is a breakout. This is a reversal. It is a breakout. Here, market reversed momentarily for a bar. So that bar, when it was down there, it was a breakout. It is a breakout. The low fell below the lows of the past several bars. So every reversal is also a breakout. Therefore, you have to look for simplicity rather than complexity in your work. And using terminology that's not too complex and doesn't need too many ifs and buts and asterisks is actually one of the important things to do. So you just say breakout mode, that implies it could be in either direction. Can be
so it means so it means a significant move or a tradable move in either direction is equally possible and is all possible.
No, it doesn't mean significant. There's nothing there that implies significance. Like here, 39 is a breakout mode situation. Okay, we have 2 legs up and we have a doji. So market is responding to this 1 bar trading range. It's a single bar trading range. A doji is a trading range on a lower time frame. And here's the breakout. It's not all that big, but it is a bear breakout. It just happens that it failed. So breakout mode does not mean the outcome should be or must be significant. It can be, and it might not be. It's just, it's one of those situations where you have, you're balancing something on a knife, and it can tilt either way, or it can fall off the table. completely.
Okay. But if you were to define breakout mode in like very specific, like mathematical language, what would you say would be the exact definition? Would it be like the probability of a measure move up is less than like 40%, or what would that definition be?
That comes from the context, not from breakout mode. Breakout mode means one of these 3 or 4 situations here. There's either an opposite setup, there's range compression, or there's a complete pattern or structure. And now the market is looking for a response. So this one you can, like all of them, if you summarize all of them down below, it's going to be market waiting for a response. That's capital R, right? To the last event. At that point, market is in breakout mode. Because every bar is the last event, every bar can potentially be a breakout mode situation, and it is. But then you have the scale. That scale can be a single bar, it can be a wedge that's consuming 4 hours of trading intraday, or it can be a double top, which is 5 bars long. Or it could be a micro double bottom, which is just 2 bars. So you see there is this range of variability based on time and price that produces all sorts of breakout mode situations that can last just a moment. A macro double bottom forms between 2 bars, and you get a response on the 3rd bar usually. So it doesn't take all that much time. But a wedge that's taking half the day to form, it takes 4 hours to form or 3 hours to form, and the outcome of it can be lasting 2 hours. But at the end of that wedge, near the end of the wedge, the market is in breakout mode because it is waiting for a response to that wedge. I hope I answered your question. I tried at least.
Okay, thank you. I'll think about it. Thank you so much.
Sure.
Mr. Ashford, yeah, I understand. Like when you use the first example for the breakout mode for the experienced trader who sees the other side and waits for a better entry, let's say, that made much more sense to me. I understand breakout mode much better now.
Okay, cool.
Hey, Ollie.
Yeah.
I'm wondering if a sort of a first principles way of looking at this might be to say that balance tends to lead to imbalance, and imbalance eventually leads to balance, and that sort of first principle would contain sort of volatility cycles and market cycles and breakout mode, like sort of all variations of this balance to imbalance dynamic cycle.
I think you're right. Yeah, because that's what we see on the charts, right?
Yeah, and I'm that would sort of address. I'm not sure who was speaking before Castro, but that kind of conflict, because I used to have that like conflict as well too. When Al would say, "Yeah, breakout mode," and yeah, what does that exactly mean? And if you think of it in terms of just a cycle, like a cycle of compression to expansion or balance to imbalance, it's this fundamental like breathing. It's like a breathing of the market. The market's like breathing.
Yeah. The best one, I think, the easiest ones at least, is I think these two: range compression and pattern completion. This is easy to see, and this is easy to see too. Opposite setups, sometimes they are not easy to see for everyone. Yeah, but
that's I guess I think of opposite setups as like a variation of the concept of balance. Like there's a balance between setup.
Yeah, that's right.
Cool. All right.
Yeah, especially when you have a pattern that's nested and it looks complete, and then it's also nested. So you see that fractally it is complex too. Those are fairly good examples of breakout modes that the outcomes usually last for, I don't know, depending on the size of the pattern, from half an hour to maybe the rest of the day. Like, again, this is a good example. Spike and wedge channel, and the last leg is also nested, so you can say big leg down, second big leg down, small big leg down, sorry, small bear leg down, and then the last leg also has 2 pauses, so 3 pushes here as well. So nested wedge, and the nested wedge is also part of a bigger structure that seems to be complete. So breakout mode here with the potential of at least controlling the market for an hour or so, because 72 to 81, that's 10 bars. And then this is another 20, 27, 30 bars. That's about 40 bars or so. So if it is correcting, it's going to correct for about 20 bars. 20 bars is just more than an hour. So for the next hour or so, the market should be sideways to up rather than sideways to down. And when you see the reaction to it, so we went from, how many bars is here? At least, so that formed the low, right? So that high, that is 15 bars. So we were expecting about 20 bars. So it's probably not over yet, which means the sell-offs here are low probability. And eventually it reached all the way up there. So completed patterns are the best sort of context or situation to expect breakout mode. And they're easy to see because you see a pattern's complete. It has many bars, see all the parts, all the building components inside of that pattern. And then that leads to a new move that is going to control the market for fairly long periods of time based on that completed structure. So,
for example, 72 could be 71 could be a completed pattern, right? Because we had multiple legs up till there and then boom.
Mm-hmm. So a very big wedge, and the last leg is a small wedge. So somewhere here, 69, 70, it's approaching that response time. So buying becomes low probability. If you look at, sorry, go ahead.
Oh, I was just going to say, so in the same way that we have the nesting of fractal context or price price patterns, it sounds like there's also sort of a nesting of these breakout modes. Whereas if you had just kind of like one type of breakout mode, it might not be, you might still be within a different, like if there isn't a completion pattern, what Khosrow was saying before about looking at what came before it and expecting continuation would make sense, because on the completion pattern nest, hierarchy of the nest, that still needs to play itself out, so there's like, it's like a more of a stopping point than a potential pure balance or reversal point. Yeah, cool. Right. Thank you.
Sure, no problem. So if you look at, so for example, here is last Friday's ETM chart. So if you look at these charts, that is the principle that I'm using to mark, for example, these bars as low probability market or stop order buys, because we are approaching the completion points of those patterns. Therefore, more in that direction is low probability now, even though the bar is strong. So 27 is a strong bar closing and it's high. It's still a low probability buy because market is approaching the point that the bigger structure needs a response. So we don't see any bear bars yet, but that's not important. The important thing is if the pattern is complete, there is a complete event on the chart that needs a response. And that means more in that direction is probably low probability, because wedges typically correct in the opposite direction about 3 out of every 4 times, which means buying 27 is a low probability buy, and it led to a failure. And then you see a trap and a second leg down. So that's the principle that I'm using to most of the time. When you see that I put low probability markers on a bar that seems strong and the trend is still continuing, the reason is that the market is in breakout mode. It's approaching breakout mode to correct a bigger pattern. Same with, like, if you go to the day before, same here. So look at, for instance, look at this bar. We have 2 or 3 legs down near the bottom of a trading range. It is still strong, so it can go down a lot further. But for immediate trading purposes, selling 21, although it's a follow through after an outside bar, is a low probability short, because this pattern looks complete. And we had a very strong bull leg. So usually you have a strong bull leg, market tests to the bottom, it's more likely to go sideways to up rather than break out below. But when it breaks out below, then it becomes high probability, and these bars become resistance. So they lend themselves to limit order shorts now above the market. Same with these other ones. So this is a low probability short because this wedge seems complete. You have a breakout leg, gets a second leg, and it is a late second leg. So low probability, it's breakout mode situation, a response is required. Now it can go down, obviously, but that is the low probability outcome. So higher probability, we're going to be sideways to up. So selling that bar is low probability because it's the breakout mode situation. Same with these ones later on. So we have another spike and wedge channel. This is leg 3. We have had numerous reversals here. Strong bar, good follow through, but low probability short. Actually, this one, I didn't even recommend it selling 50 because it was so late in this. So really a strong breakout mode situation. Right, so
Ali, can I ask the question?
Yes, please.
Is it fair to say that you could use market indecision and breakout mode interchangeably to sort of, or am I oversimplifying it?
Market indecision is definitely one of the 3 or 4 options for breakout mode designation, but it is not always correct. It's not always the case. So for instance, all of these dojis are market indecision, and market is in breakout mode on each one of them. But what about the completion of the wedge? What about range compression? What about 2 opposing forces? Big up, big down. So those are all the other ones. So definitely what you said is correct, but it is part of the whole thing. It's not the entirety of it. All right, so I think that's good enough for breakout mode. I think we covered all of everything there. The next thing we want to talk about is a perfect breakout test. Where's that whiteboard? Okay. So first, before we go there, if you want to do a research on breakout mode, find all types of breakout mode. 2, consider context. So what was the effect of context on breakout mode outcome. And if you want to do a little bit more, so that's like A and B. Study charts. And explain why every single bar is in breakout mode. So that's 1, 2, based on that, based on the response. How can you structure new trades? Okay, little bit of hint here. Usually, if you do this, the best type of new trade is a limit order trade when the response is strong. Okay. For instance, bar 43, bad buy signal bar is a bad high 2. High 1, or maybe high 3 even, down once, down twice, down 3 times. So potentially high 3. But the bar is bad. It's a weak bar in a whole bunch of dojis and bear bars. So breakout mode situation with possibly more sideways to down. So up and then maybe down or immediately down. Still a bear environment, right? Gets this tremendously strong response. So the high of the bar is support now. There's a limit order there. Or here's another one. So we have 4 bars down and 2 bars up. This bar is close on the high, but still, bears probably need one more leg sideways to down. But they don't get it, and then there's a bad sell signal bar testing that high. So potentially, there's a limit order here to buy below that doji bar, expecting trend resumption up. Stuff like that.
So in a sense, limit orders couldn't exist if there was no breakout mode at some lower fractal time frame, right? Is that the idea?
The idea is to find situations where the opposite side has a good argument,
Right.
but they don't take control in that direction. They fail basically.
Right.
And then recognizing what was the bar where the opposite side actually could come in and express their opinion, but they couldn't control the market. So that bar now becomes support or resistance, and it's usually a good limit order entry.
Right.
Yeah.
So there's breakout mode on a very small time frame, but on our
Correct.
time frame,
yeah. But you don't look at that time frame. You just look at this chart. Yeah.
Right.
And then
but that's what makes it possible. That's what gives us the opportunity.
Yeah. Understanding the thought process that the opposite side has gives you the opportunity to not requiring a lower time frame chart to be able to see what's going on and then trade with limit orders.
Right. Cool.
All right, so let's move on. Okay, so next topic. This is an easy one. So we have breakouts, and the breakout is usually tested, so it leads to a breakout test. And sometimes this breakout test, so we have different kinds of tests. So let me do it this way. Erase that. And let's do it this way. So what type of breakout tests do we have? So what should I write here?
We have a breakout point test, so it's testing the breakout point for the prior bar, let's say.
Yeah, so there's a
Gap
test
below.
there that can do one of these things. Close, breakout gap, BOG, leave, BOG open. Okay, typically it's these two, right? It either overlaps the breakout point, so it closes the breakout point, closes the breakout gap, or it does not reach the breakout point to close the gap, so the breakout gap is remaining open.
Or there's a
what-
body.
Pardon me?
I'm saying, or there is a body gap. So it overlaps it, but not overlapping with the body of the bar.
That's still an open breakout gap,
Okay.
right? But what if it's a perfect test? Perfect test. Do you remember the discussion that we had early in this session that pointed out that some of those micro gaps are zero height gaps? That is what this is. It's a perfect test. So for example, you had the trading range, and that was the bottom. Okay. And we get, a bear bar here, and we get a bear breakout through that bottom. And then the market comes back and tests that line, but there is no overlap. It's just a perfect test. So there's a bar here with a tail there and a bare body. Okay, so that's a perfect breakout point test. So why are we classifying these differently than the other two? Because really it's a variation of the second one, really, or a variation of the first one, depending on how you see it. Because the breakout gap is touched. There's no overlap. It's only touched. So you can say that it realistically, at least a little bit of it is still open. Okay.
Is it because the people who bought the close or sold the close on the wrong side when it got tested couldn't actually exit break even? Because they would need to go one tick and yeah.
So that breakout, the perfect breakout test, is actually usually, this doesn't give me that. Okay, it doesn't matter. It's usually, if I can get this, that would be nice. Okay, it's usually like that. So I said it touches it, but the classic way, the way everybody else is looking at it, is that there is one tick open gap. So the textbooks require that there is a one tick open gap. However, my research into micro gaps show that even if there is a touch, like I showed you on the micro gap zero height, type of micro gaps, if there's a touch which creates basically no gaps, but there's also no overlap, it's the same as having that one tick open gap. The probabilities are so close that you cannot really separate them. That's why I said, that is why I put that option in that indicator when I was writing it. It was not there. If you look at the first version of the micro gap indicator, there is no provision for a zero height gap. But when I did the research, these are doing the exact same things. They have the cumulative effect. They provide support. The probability numbers are very close to an open gap, at least one tick gap. Therefore, I think of both of them as the same thing. So for me personally, there is no requirement to have a one tick open gap. it can't be just a perfect touch. So therefore, I'm going to say one tick open gap or no overlap, but test touches support or resistance. Breakout point, basically. So both of them are the same. And you're welcome to do the research on your own and see what you find. But that's a perfect test. So what does the perfect test indicate? Perfect test.
Strength.
Yeah, exactly. It's a sign of strength. And it usually, so not always, but usually also results in a trading range. Because realistically, we retraced all of the breakout to the point of the breakout. So that is usually a deep pullback. And if that is the case, then whoever brought the market to that price again will usually try for one more leg, one more attempt to completely fail the breakout. So most of the time, breakout tests result in trading ranges. And that doesn't take away from the fact that the side that created the breakout is still controlling the market, because they couldn't prevent the gap to shrink to almost zero, but they at least prevented it from getting an overlap, so that they have an argument still. So in this case, bear breakout results in a perfect test. There's probably going to be a second test up, but then there's a chance for trend resumption down as well. Do you remember the discussion we had about a depth of pullback? And I said it's like the two gangs fighting and one of them goes into the neighborhood of the other. And if it goes really deep into the neighborhood, then it's hard to throw them out. This is on the same theme. It's a deep pullback, so it's going to have a second leg, but also the breakout point is not overlapped. So the breakout side has still an argument for trend resumption in the direction of the breakout.
So in terms of that line of thinking, would it make sense to think of it to see as trending train range as long as you're in the right place in the market cycle?
Trending trade, you mean the day structure?
Well, in the sense that you were saying, it implies strength and it also implies trading range activity. To me, when I combine strength and trading range, I think trending trading range. So the expectation is continuation, again, if you're in the right part of the market cycle, but two-sided trading to get to that next destination.
Yeah, that's what I said. Yeah, you expect the deep pullback to have one more attempt. That's usually the minimum.
Yeah.
Less likely to see a V forming here, like touch and crash. That's very rare. But then the side that's controlling the breakout, that produced the breakout, because they are preventing an overlap there, they have an argument for trend resumption in that direction. And sometimes
like that.
Yes, go ahead, sorry.
I was just going to say, like a perfect trending train range, which of course never exists, but if it did, would be a series of those, of exactly what you're saying. It would be like a perfect test of the prior breakout point, a little bit of train range activity, continuation, another perfect test of that breakout point. The market doesn't really work that way, but some variation of that.
Yeah, exactly. I was going to say that it's fascinating because sometimes you get these perfect tests and then a huge trend comes out of it. Initially you say, okay, it looks like the bear breakout, for instance, in the one that I drew, failed, but then it gets a perfect test, and then sometimes the second one is exactly the same, or it is a little bit lower, and then tremendous follow through. bear breakout and then just never stops.
Yeah.
That strength is still there. It's very deceiving because when you see the market reversing this all the way back to the breakout point, you think that the bears failed. For example, this is the bear example. Bears failed, but you shouldn't forget that a perfect test is also a sign of strength. So although it looks like they have failed, they might not have failed. And so mentally, it's important to recognize it as a sign of strength and be open to actually seeing a very big trend coming from it.
Yeah, and if we asked you that as a question, your answer would be based on context.
Or wait for the evidence of the new trend resumption. That's also possible, right?
Again, depending on context, right? How much you want to wait, right? If you're at a great context, maybe you don't wait that long. If you're at a ambiguous context, maybe you do.
Yeah, that's correct. All right, so then the next thing I want to talk about is relative strength.
Ollie,
I don't think we have time. Yeah, go ahead. Yeah.
Before we move on, so with these breakout tests, the idea that there's a perfect test or even a one-tick gap, does that not indicate that there are trapped, in the case of the drawing, there were trapped bulls, and those bulls are trying to get out, and if their orders do not fill, then and the market reverses, then they will start to panic out, and that will add strength to the downside.
I 100% agree with you, Phil. Yeah, that's correct. You know why? Because on every breakout, I'm trying to find examples here, as you see. Every breakout, every market move has two sides to it, which means even though we are not seeing it, like for example here, as the market's going down, there are people buying. There is always somebody who's doing the opposite. There are very big companies that are paid to do that. Okay, they are trading companies. Some of them have market making operations. Market making operations, as its name suggests, it means doing the opposite. So market's going down, people want to sell. There should be somebody who wants to buy from them. So there are companies that are paid to do that. And the fact that they're still in business means there's a way for them to survive doing the opposite. It's very important that you think about it. So if they have a way of surviving doing the opposite that everybody else is doing, means the probabilities, directional probabilities, are never as high as they seem to be. Because if they were, there would have been no opportunity for a company to hire staff and have a big establishment and do the opposite and be able to generate enough profits to pay for all of that and then some. All right. So yeah, I 100% agree with you. There are usually
from a trading standpoint, is it better? I always kind of wonder about this. Is it better to put a limit order, like maybe one tick from the breakout point, expecting or hoping that it gets filled and then reverses from their point? Or is it better to wait for the test to happen, see the result of the test, and then enter?
Both are correct. It depends on the situation in hand and the amount of energy and momentum that you see the market is showing you when it is approaching prices that it needs to go there and test. If the approach is too strong, it's usually better to wait. If the approach is a leg in a trading range, you can't front run it. You can front run the test or reversal. That's the general recommendation. But then everything has sort of, exceptions and things based on the context. This is not the textbook example, but it's actually a fair example. It's a good example. So I'm just going to mark this bar. You know, I was fishing for a perfect test example to show you. All right, so what do we have here? We have, you know, potentially a bearish trading range day because we went to a new low of the day later in the day. That's more significant than the early high of the day. And then we are back at the high of the day here. So new high of the day there. Now you know that it is an expanding triangle. So if it's an expanding triangle trading range day, it shouldn't go too far up before it reverses. It shouldn't go too far down before it reverses. And by the signs of it, this day is reversing every 3 or 4 bars. So here we have 3 bars. It's a late bull leg when there has been 2 legs, and this is complex. So this might be the end of it. And it's also the first bar that is crossing that 200 bar moving average, which is strong resistance or strong support. So this is one of those breakout mode bars that the market is at the tempo cycle, and it is breaking out of resistance. It is also a late leg in this structure in a trading range day. So buying that bar is not all that high probability, despite how strong it looks. Gets follow through, so now it is support, and that's the perfect test. You know, test to exactly that high. But look at the approach, right?
Yeah, that would have been very scary because that bar
Yeah.
of 7 would have been a very big
Yeah.
bar coming down to that test.
Mm-hmm. But if you recognize it, you recognize that this is a perfect test. So the bull side still has an argument despite all of that. But then this also will probably produce a second leg sideways 2 down at the minimum 1 bar. So this bar 7 is a low probability buy. There are sellers above. We get the leg down here, 1 bar, and then there is 9, which is overlapping completely. And then there is a second reason to buy this bar. So it's not all that high probability, but because of the perfect test, the probability is higher than it looks like to buy below 9, because bulls bought and everything is 2-legged. So once and twice, they're going to attempt to buy 2 times. So 9, because of that perfect test, has a higher probability, despite all of this bearishness, to produce at least a profitable buy scalp, long direction. But to answer your point, Phil, there's nothing wrong with waiting for this to start working. And then usually there's a bad sell signal bar. Here is bar 13. There are buyers below that, and there are buyers lower at support. Any sort of support that you can find. You know, in this case, it's a 4-bar bull macro channel, and 12 is the last strong bar. It also has a tick gap. So buying below 12 seems reasonable. When there's a weak sell signal, there's no reason to sell that bar. So it's probably going to be a trap. Now, if you buy there, you can scalp out on this bar, bar 14. Or if you think about the dynamics of the trade, if you take bad signals, your stop is going to get hit. So if somebody takes a short here and puts a stop above 13, that stop should get hit, which means if I'm buying below 12, I can hold the trade long enough for that stop to get hit at the minimum, which I call hunting for the stop. So it's actually bigger than a scalp. So it's a scalp and a half sort of a profit. And all of that is predicated on recognizing there is a perfect test there, and then different ways of structuring a trade. This is the most aggressive one, to buy below 9. Buying 10 is okay, not great. Buying 11 is higher probability, but when it is higher probability, it probably should get a pullback, but it doesn't, which leads to the best trade, which I just explained.
Okay, thank you.
Sure.
Hey, Mr. Afshari,
Yep.
for breakout points, do you know how you use just the traditional term you used? It's below the bar, for example, that it broke out. So in this chart, 63 and 64, 64 to the right.
Oh, here?
Yeah, so
Yeah.
64 broke below 63, below the low of the bar.
Right.
So that's a breakout point. But you also see the breakout point from being from the top of 63, and that's a breakout gap from there rather than just the low of 63, because the
I
market's breaking out there.
it's a breakout test. So we had the breakout here. We fell to a new low of the day. Same line that I just erased.
No, I know.
So,
I'm asking for a breakout point and the breakout
okay.
gap. That's what I'm asking.
There are a ton of them. Every bar, the low of the bar and the high of the bar can be a breakout point. So for instance, 45 is breaking below the low of 44. So 44 low is a breakout point. And
But
this
so
is
is the
testing
high
it.
of it, right? So because it's like
High
a
of
price.
it,
Yeah, because it's
not
breaking out.
really. No, high of the bar. This is just a breakout of 43. So low of 43 is breakout point right there.
So for the example of 63, that
Mm-hmm.
the bull bar, that 64 broke below it. I know it broke below that, so the below of 63 would be the breakout point. But isn't there from the high of 63 till kind of where 64 broke out, all of that is a breakout gap, and that's a breakout point as well,
No,
because like the market is breaking out from the high of 63 as well. There
yeah,
was like a point there and it's
I
breaking
know.
out. Shit like that?
No, no,
Okay.
that's gonna
Confuse you? Like
yeah,
confuse
confuse and
the trader?
misguide you. Here's a bigger example. Here's a trading range. Okay. Bear trend potentially started there, potentially started here. But this is not the breakout gap. This is the breakout gap. Same thing that you're saying. You're saying the breakout gap started here, high of 63.
Yeah.
Okay, so same thing. Leg up, reverses down. Leg up, reverses down. No, this is a trading range. Market is breaking out of the bottom of it. So the breakout point is either this low or this low if you're more generous. But it is not that high.
So you don't view the breakout gap from, let's say, the high of the bar till the
No,
breakout point. Okay.
no, no. But if you're using a spike to produce, measured move targets, then that's fair to use. You can use, for instance, in this case, you can say the spike was here to here, so there's a target down there. But even so, you see, the market doesn't really care about that target, but I think it will care about the one that is based on the trading range. Okay. See, responding to this a bit closer than that, because this is completely ignored, it just fell through. Which means market is not paying attention to this. So maybe this is the spike that the market is looking and ignoring the little pause there. And you see that one was the one the market had in mind, which is close to 2 times the range of the trading range.
Okay, thank you.
Yeah, sure. Okay, so let's start looking at higher time frame charts. So next time we're going to talk about relative strength, if I forget. Daniel, you had a question, I think, and I said I'm going to answer in this part, right? You're there? I don't see him. Okay, so hopefully next time. All right. So all of the lines here should be readjusted because we had the rollover. So I'm not going to waste your time adjusting the lines now. I'm going to do it on my own later. But there are some important ones that we're going to need. Probably this one is one of them. Get rid of that. Okay. The rest, not very important. I mean, we can actually probably erase this one. That's okay. And this one is also important. I have to put it there. Not so much this one. All right, so if I go to monthly chart, this week brought us to the midpoint of the month, almost. So this bar is now a big trend bar, and it touched the monthly moving average. Monthly moving average, important. Look at what the market has been doing with it. Okay. Important support whenever it is above it, important resistance when it is below it. And if you look at these charts, longer time frame charts, what comes across immediately is if the market is in a trend, small pullback trend especially, you get an opportunity to buy at the monthly moving average about once a year or once every 2 years. And if you're looking for, investments in sort of like retirement account style of buy and hold, that's probably one of the good opportunities to look for buying at that moving average whenever the market is there. So this week we finally reached that price, and this is the first time we're reaching the 20 EMA on the monthly chart after we've been above it for almost, so we crossed there more than a year. So a year and 3-4 months. Sorry, say again.
It also perfectly coincided with an exact 10% pullback, like almost to the tick. Kind of amazing.
Yeah, exactly.
Like it was literally, I don't know about on the futures, but on the composite SPX, it was literally like to the penny.
Yeah. We can probably find out. So give me 1 second to see if I have it on this computer to begin with. I have even forgotten the name of the indicator or program for it, but I don't remember even the name of the indicator, but I've written an indicator that looks at this chart, finds the all-time high, and places retracement levels based on percentages because people pay attention to those things. Just going to look at the top of the list one more time. Yeah, okay, got it. Here it is. Okay, so if I put that on this chart, and here so you said 2%. So let's use -2 for this one. See what happens, right? So from the all-time high, this was a 10% pullback.
Yeah, exactly.
Yeah. And then 20 is here, and this one is yellow. This was intended for a dark background chart. Yeah, so we had a 10% pullback. Usually the first one that's really important is 2 or 3%. So if you look at this one was 0 because 2% is not really all that important. But 3% is important, 5 is important. You'll see institutions pay attention to them because when you are in sort of a strong bull trend and you get a 3 to 5% pullback, there's usually tremendous interest to buy again. And then the next one is 10, 20, and so on. So this was also a 10% pullback. So we expect some reaction to that. And also it coincided with the monthly moving average as well. And also, you know, the trap price here. So just give me 1 second because I have to adjust this chart. It has 0 bars to the right. Because of that new indicator, we're going to give it some space. Let's say 20 bars to the right. Right, so now it has space. Okay. Right. So so the expectation based on last week was we're probably going to continue down, but then we're going to find a support level and bounce from it. But on the monthly chart, it was not clear yet because the bar was in progress. On the weekly chart, it's a bit more clear because this was the last week's bar, and it's a big bar, and it doesn't have a very good close. So there's a tail below. That tail indicates buying pressure, and that buying pressure for institutions is usually untimely. They're not very good in timing the market. So they start buying when they think the market's at support. They start selling when they think the market's overpriced and it is at resistance. And they're usually early in most cases. So therefore, you expect buyers below that tail. And the bar is large, so that reduces the probability for this week to be another big trend bar. It increases the probability for this week to be a smaller bar. Now, sometimes we get extension like this, but usually that's what happens. The range of last week was 327 points. Range of this week is 100 points, almost 80 points, sort of less. So it led to a smaller bar, but not that much of a smaller bar. Typically what happens is this. So clearly bigger bar, clearly a smaller bar, or even if the range is similar, the bodies are different, the body is smaller. And sometimes it is an opposite bar. So big bar, next bar is an opposite bar. But this is not a buy signal bar. Therefore, the expectation at the minimum is that we are going to retrace the tail because the tail brought the price up to the close of the bar here, and we're going to fall below the low of the bar. So if you buy this bar and put a stop below, your stop is going to get hit, which means we're going to go down. So that was expected. But because of the tail and the size of the bar, it's also expected that the next bar is going to find support and reverse up, which is what happened. So now considering the first half time, second half time of a bar life, that means for the first portion of the week, we should fall below the low of the prior bar and then find support and reverse towards the end of the week. That was the general idea. And in the process of doing that, then we see how far the market goes and what prices it can reach. The round numbers are important and prior support and resistance. So this was a failed sell. The low and close of the bar are close together. They are both important. And there's also a failed gap there. So there was a gap down that failed. So that leads to estimating support around 5,600. Let's look at the daily chart. So tremendous tight bear channel. It usually resists reversing. Problem with this sort of bear channel is that because there are small, weak dojis and bull bars inside, it doesn't get climactic all that easily. So that the pressure is sort of relieved as it is going down. And that sometimes leads to tight channels, lasting for a very long time. But the expecting one to be a very long tight channel is actually low probability expectation, because most of the time, after you get 3 or 4 pauses, then the market reverses. And as you probably have guessed, seen, in the end of day charts, when I write, I was not very bearish. I was looking for a reversal. But sometimes you're looking for a reversal and market still has some ways to go before it reverses. Just give me a second. All right, so we have a potential spike and wedge channel here, parabolic wedge. This bar was one of those breakout mode bars that you expect the market to go up. But if it goes down, then it becomes resistance and you get two more legs in the new direction. Don't forget, this was, look at the date, right? This was the last bar of last 2 weeks ago. And I just mentioned that the weekly chart was suggesting that we're going to test below the low of that weekly bar, which means this signal for a buy should fail. Therefore, even if Monday would go above the high of the bar and trigger the buy here, it was still low probability because of the weekly chart. It just happened that it didn't. It gapped down and fell first. Now, if somebody takes this as a parabolic wedge and that for a buy signal, not paying attention to the weekly chart, their stop is just hit. Now, if they scale in, they buy here, they buy there, and maybe one more time at support, then this would be the cost average of the trade. So that should serve as resistance intra-week as the market is coming up to test. Also, it is the bear breakout point. And this was a very close test. Low 57.25 and a quarter, high 57.27 and a quarter. So only 2 points overlap. 2 points. This market bars are 200 points. That's not important. It's equal to a one tick test. Right? It's such a small amount. And then we get follow through, breakout and follow through. I wrote on the end of day chart that when you have two strong bear bars, one of them at least strong and gets follow through, that increases the probability for at least one more bear bar. So the first reversal up is low probability. And there were other reasons, as I just explained, to expect sellers above that bar. But then from the higher time frame analysis, we expect the market to find support and bounce after that weekly bar gets its breakout. So here's that end of the weekly bar gets its breakout. It is a strong, expect one more leg down. And then there should be a reversal to produce a smaller bar for this week. And here's that bar. And in the process of getting to Friday, we also have a bull breakout. The high went above the high of the prior bar. And this is not the first time. This is a old bear leg. It's at support. And we have had other buy signals that got triggered as this was going down. So if you take, for example, the first part here as the spike, it's 1.5 times already. If you say this was not important because it's also still a bear bar, take that as a spike, which I think is probably what the market was paying attention to, then we are right at the measured move target from there. So we should find support around these prices, 600 or slightly lower. And that led to the Friday, reversal. This week behaved exactly as expected. It's very interesting. So having that in mind, looking at 10th, so this is too much in the past, 12, 11 here. All right, so 2 Fridays ago, we had this tremendous reversal. We talked about this chart, so I'm not going to repeat myself. I think, was this the chart we talked about? No, we didn't talk about this. It was similar. So There was another same type of a day structure. Early high of the day, new low of the day, new high of the day, so expanding triangle. You expect sideways and trend reversal down to the middle of the range. So this day ended with sort of a double top with a very good signal bar and a breakout after, but it is also not clear whether it is still always in long or not, because this leg is also very strong. So breakout mode situation with the caveat that the market is in a bear trend on a higher time frame, and falling below that low of last week is very high probability. So we expect this to work and this one to fail. A very big gap down on Monday. Let me stretch this for the bars to look right. Okay, so very big gap down, 104% average daily range. So one average daily range already down. Low probability for the market to produce another 100%. But sometimes it does. And here's an example of how it happens. More likely, this is going to be a trading range day, which means if we go down some more, which usually when you have a gap, big gap, there's a tendency to produce a tradable leg in that direction, the direction of the gap, in this case down, in the first 1 or 2 hours of the day. But if that leg produces a even bigger range down, then the probability for the market to not go down goes up. Because if you're past that 100% average daily range, for it to become 100, 50, 200, 300% average daily range is low probability. You usually don't have very large bars on the daily chart. But there are some, and if it becomes one of them, then it can go a long, long way. There is usually, as I explained, there's usually some other contextual reason for that big bar to form. And in this particular Monday, the reason was we should go below the low of last week because of momentum. So let's just cycle back to that chart. So here's the low of last week, 57.25 and a quarter. . 57, actually it's very close. Yeah, it's this bar. It's that line there. You see already the line is there, right? Actually, we don't need it. So here's that line. We should go below this line. We dropped below and tested it, and then trend resumption down. So what do we have here? We have a spike and parabolic channel here, leg in a trading range, and the market tested up to the area of the first visible pullback, because this was the first pullback, but this one is actually visible. Micro channel, first pullback, and trend resumption down. So all the whole price structure here is a leg in a trading range, from that high to this low. If the market breaks through this trading range, then it might go a measured move down. It's in the direction of the higher time frame momentum, so it has higher probability for dropping down there rather than reversing. The trick here was to recognize that trading ranges do not necessarily have to have a correct shape, which means a complete leg down followed by a complete leg up and then a breakout. The trading range can be just one leg. As long as you can label that leg as a leg in a trading range, it's a trading range. It doesn't have to have all the components. And why is that? Well, because the same discussion that we had earlier today, if the market is in breakout mode, the breakout has two possibilities, a lower probability possibility and a higher probability possibility. The lower probability doesn't mean no probability. It means just it's less frequent. So a leg in a trading range is a complete price structure. Higher probability for it to reverse and test up to the top of the range. But that is not guaranteed. What is guaranteed is a response. And that response can have a range of variety, can be in several different types. It can test half a way up and then get a breakout. It can test all the way up and then reverse and break below. It can test all the way up, go sideways, and then break out on the top side of the trading range. All of those things are possible. So based on my way of thinking, that is based on minimal vector analysis, if you have a leg in a trading range, you have the minimums for a trading range. From that point forward, there's a response to it that the market is going to produce. And if the response is extension below the trading range, that leg is doing its thing. It's producing the trading range. It's half done. That's okay, but it is there. It's just that the market response to it is further trending and breaking out below the low of the supposedly half-finished trading range. So that was the trick, really, to reconcile what the market was showing us on Monday, because there were a lot of contradictory, conflicting information. This was a big gap down. They shouldn't go all that much down lower. It did the minimum required, which was running the stop, below the low of the weekly bar. And in doing so, it produced a leg in a trading range, which is the basis for expecting sideways to up. And then it broke and went down to a measured move lower. So very, very, very interesting day. Now you can, just 1 second, you can take the same argument and put it here too, that here's another leg in a trading range. And it now has higher probability for reversing because this seems to be too steeply down, so it needs a second leg down. Here's a second leg. It's a wedge. It's a possible lower low major trend reversal. But this didn't go above the high of the swing point. So the major trend reversal argument is weaker. But it is also a leg in a trading range. And usually when the market does something, it continues to do the same type of a thing on and on. At least for the second time, there's sort of like 70% chance for it. So leg in a trading range gets a 50% pullback, goes to a new low. Leg in a trading range gets a 50% pullback, goes to a new low. Castro.
I was thinking, does it or does it not, the idea of the neighborhood fight apply here in this structure?
How come?
I'm saying, does it? I'm asking, like, does that neighborhood fight apply here? That it kind of, the move comes down and then it stays around the bottom of the trading range?
Well, this is all a bear leg, and it gets a 50% test. So the fight was taken up to 50%. Okay, so more likely, whenever the pullbacks are about 50% or less, you have higher probability of trend resumption. So this is not going very deep. It's not getting to 70, 80%. So higher probability for it to resume the bear trend. So yeah, I mean, every pullback in a trading range is that, but you have to measure the distance and see how far they're going. If they're really going up there, then it's probably going to stay up there. But this is going to about 50%. And whenever it's about 50%, you have still a good shot at trend resumption. 50% tests are very common. And again, so here you look at what is failing. Here's a bull spike and it failed. Bull spike failed means there is a measured move target in the opposite side. 1 and 2 times. You see the buying pressure coming in at one time, the range of the spike, and then this gets to, I think, the higher time frame support, and then there's a bounce there. Also, you know, prolonged bear channel gets late strength. That is low probability. It's low probability except when there is a tremendous market correction. You know, in a bear market, you know, a crash, a recession, you would get these, and then they will never stop. They'll just continue to go down. But we are not in that kind of an environment yet. So low probability for selling. Also, if the day is going to be a trading range day, which it seems it is, why am I saying that?
Why does the day seem to be a trading range day? Is that
despite all of the selling, despite the big range?
Every time bulls are buying lows, they're able to break even later on.
Yeah. Yeah. So scalping the bear breakouts by fading them is actually working all day long. So look at that. Big bear bar, they bought. Big bear bar, they bought. Big bear bar, bought. Bear bar, bought. So like every gap is closing. When that is the case, the market is still in trading range. That leg in the trading range can go ways down, but that doesn't take away from the fact that it is a leg in a trading range. And if it is a leg in a trading range, it's going to get pullbacks. Gaps should close. So when you see 69 outside up bar after all of that sell-off, it's not all that low probability, because this was the only section of the chart that fading stopped working, and is late in a bear channel. Day is overextended. Let's quickly do this just for fun. So that was the close of the prior day, and this is the open of today. And how far low are we going? So let's turn that on too. Change the color to something we can see, maybe light blue. Okay, so that's 100% of average daily range. That's 200%. That's 250%. Very odd for a day to become 300% average daily range. So this is probably not going to continue.
Hey, Mr. Afshari?
Yep.
This might be too much of a broad question, but I'm still gonna give it a shot.
Yeah.
Do you think there was higher probability to buy below this day or to sell above?
It's still a bear surprise, as I mentioned on the weekly chart when we're talking about the weekly chart. So when you get a surprise, let's take a look at the weekly chart. Sorry, daily chart. When you get a surprise, there's always more likely to have something in that direction because it's such a, you know, big momentum, big trap. But it's also a point of clarity situation, and when you have a point of clarity on any chart, the pullback is more likely than more follow through. So although big bar, yeah, I mean, probably going to have a second leg down, but it will probably also get a pullback first.
Yeah, thank you for saying that. I was asking more for the intra-bar days, so intra-bar price action. So when it was getting bear breakouts, was it like higher probability to buy below the swing points in the bear breakouts, or just sell above? Like once you get a bear breakout, you would sell above that
Well,
for a scalp.
depends on traders' personality and skill level, and you know what they are set out to do.
Yeah, it's too broad. It's too broad of a question.
Yeah, it really depends. It's a very personal question, but I think the correct teacher's answer is to say you always have to align yourself with the direction of market regime, or always in direction, and trade in the always in direction. That automatically takes away all the fades. It's like, no, you're not allowed to fade anything. You look for pullbacks to sell or pullbacks to buy. And if you constantly do that, you're going to see that you're going to be profitable. You're going to have some losses for sure, because when the market is in a trading range and has deep pullbacks, you're going to have trades that fail. But trading in the always in direction, utilizing, some advanced techniques to, grab the pullbacks before there is a signal bar, stuff like that, that is a very good way of trading. So that's the official answer.
That's a great answer. Thank you.
Yeah, but the unofficial answer is that look at yourself, and if you feel confident and capable of handling fades, then you can join the market makers and make money there too. There's no limits really. All right, so very big reversal up puts the market back in always in long. So this will have consequences. And we have a triangle towards the end of the day. So market is in breakout mode number 81 with a possible more bullish outcome on this chart. On the higher time frame chart, it's not as bullish because of all of that selling. So it is easy to, when you look at this, it's easy to see this and forget that. But you shouldn't, because this is that. This is the extent of sell-off. That tail is the extent of the buying pressure. So which one is bigger? This is bigger. And there's also a trap there, So yeah, I mean, great, bulls put a dent on it, but it's a dent. It's not a, they didn't totally destroy what bears did. All right, so next day we have, a 24% gap down, which is an ideal gap size. Anything above 20 and below, let's say 40% gap on the open is a good gap for that direction, because it has momentum, it puts distance, but it is not as big of like 100% or 80% gap to completely remove the range from the day. So there is still range left for, in this case, bears to still go down. Also, this was a lot of selling, and at some point you look at this and say, all right, there was a bottom to the trading range that the market was forming. 45 is a good candidate, It's several buy signal bars down, and this one had a good trigger. The next one that was a good candidate was 53. So either 45 or 53 should be resistance. So there's an area of resistance defined by these two bars from the buys that failed. So roughly there. And you know what I think? I think of 57 as inadequate test, because if you bought there and you bought lower and you're expecting this signal to work, you're not going to be taking profits as 57 is going up. You're hoping for 57 to close there and then get follow through. But when it does that, it becomes a trap. And anyone who has traded long enough has experienced this firsthand. So looking at your P&L, it's going up, it's going up, it's going up. There's no reason to close the trade, especially when the context is right. It's like a high 4 or, a high 4 setup, which is very high probability to buy. But when it does this, then you all of a sudden kick yourself and say, oh, I had this great profit. Why didn't I take it? But you're not alone. Everybody else is there too doing the same thing. So this is not an exit for whoever bought here. Some people obviously sold, but that trap is still not diffused. That's my point. So again, test into that area, you see failures. So this resistance is still in place. And then on Tuesday, we also had the jobless claims, JOLTS. sorry, not jobless claims. JOLTS is job opportunities, like how many new jobs were created. That report coming in at 10 o'clock. This bar, 10:05. This bar is the JOLTS report, and that usually jolts the market a little bit. That's why they call it JOLTS. So one of the situations where you shouldn't be in the market when you're expecting that report at 10 o'clock. It's better to wait to see what the market does with that bar, with that report, and then trade. It usually lasts for somewhere between, it's not like FOMC that lasts for half the day. The effect of it is about 5 bars or so, as you see here. But that outside bar is the report. So forgetting about the report, because 10 years from now, nobody remembers there was a report on this bar or what report was on that bar, but you can explain the market behavior from a price action point of view. And that is a micro channel that failed. Low of the bar is resistance. So this bar is not a good buy. Simple as that. And this is also roughly 50% pullback to the range of this. And if you think that somebody bought 6, they had a bull bar here, and it is followed by a bear bar, and then the market fell. So the bottom of that bull bar, which is here, is probably going to be resistance up to the midpoint of that tail. So this is testing that area as well. All right. But whenever you have a bull spike against the bear trend, the market is already in a trading range. So bull spike against the bear trend, market is already in a trading range. If it tests all the way to the bottom of that spike, which is this line, the low of the prior day, there's usually a limit order buy there. Now, same thing that Phil and I discussed earlier. Don't be too eager. Look at the approach to that price. If the approach is too strong, either cancel that order or wait for something else to form and then buy. Or if you are still adamant to buy there, you should be able to scale in. That is a requirement, which means that limit order is half size, 1/3 size, 1/4 size, something small, to scale in again. This is a macro channel approaching that price. So that is the case to cancel that order. Although there was a scalp here, so they bought there and scalped out, it's better to not buy because of the bear macro channel. But when the macro channel becomes a parabolic wedge, so a spike, down once, down twice, down 3 times, then fading that late leg is actually a higher probability trade than buying that line with the limit order. So buying below 14 is okay. Still, you have to be able to scale in, or wait for the market to reverse and then hope for a low one short, which is a low probability setup in this case. That's bar 18. And then if you want to fade something, at least fade that, because then you have some structure around that trade. 18 is a bad low one short. It's also an inside bar. So buyers below. And if you go by my rule, that there is a stop up there for the bears, that stop is going to get hit. But in the process of getting there, you're actually now in the fade direction, in the buy direction of a 3-bar bear macro channel. High, lower, high, lower, high. So any macro channel is a spike. So if that spike is going to fail, you should go up for the opposite measured move, which puts a target there. Okay. So 2-legged move to that target, and then we have 3 legs up. 1 here, 1 here, 1 here. And then the last leg seems to have smaller pieces, up and down, up and down, up again. So this is, a nested wedge really, with the last leg being a parabolic wedge. That is a good setup. It doesn't have a sell signal bar, and it doesn't really need a sell signal bar because if the market is in trading range, and it is, legs reverse based on a structure and support and resistance rather than signal bars. So there's a sell here somewhere, but you have to not look for a signal bar. If you get a signal bar, a bar that looks like 23 or looks like even 66, with the lower tail, but the context is good, they're all okay to take them, with the caveat of being scaling in at least once. But if you don't get it and you're waiting for it, then you get something like bar 30 that suddenly reduces the probability. So selling 30 needs a swing sort of mentality because your stop loss is up there. Let me show you. There's stop loss is up there. Entry is here or here. So if you're looking for 1 unit of risk to recapture, you have to exit there. And in the process of getting there, you have to sit through a pullback. So it becomes a swing. That's my point. How to scalp it? Well, you at least need follow through, or you need a pullback that tests an area that's supposed to get a pullback but didn't get. So this bar, big bar, usually crossing the moving average, most of the bar is sticking above, usually goes sideways first. If it doesn't go sideways, then it produces good resistance for a limit order short. And this one just fell. Because it fell, the low of 30 is going to be resistance, and that is a limit order there for a sell. Problem is the same old problem. The approach to that price is a bull micro channel. So now you might not be able to sell there because this can be, don't look at the chart as it is because this is just how this one formed, but that does not necessarily mean that every time it's going to look the same. All right, this looks like a minor reversal and test down is likely, but the test down might come after a two-legged test to go up, a low 2 rather than a low 1. So selling there is a little bit premature. Go ahead, Jason.
Yeah. So my question, sorry, as you were going back and you were talking about bar 12, you said that bar 12 was not a good buy. Why is that not a good buy? Because you're vacuuming down to the low of yesterday, and that's a high probability trade, and you got a 15-point scalp on that on the next bar. And then you could even scale in below that. So are you talking about it from the fact that you just have a lot of momentum down? Because you do get vacuums up and down to lows and highs on a regular basis.
I also said that you have to look at your level of comfort and skill to be able to do fades. But but for somebody who is probably just starting limit order trading, these are the types of fades that they have to avoid.
Okay. So if I've built a system around those fades and I understand it, then I could take it. So I just didn't understand because it's always vacuuming to that point. And
certainly.
But you can win 90% of the time if you take the other side. But okay, got it.
Yeah. There's a whole argument of actually fading everything that looks good because of that point of clarity concept.
I fade that every day.
Okay, cool.
Thank you.
So whenever you bought your jet, take me for a spin in it.
Well, it's the bad days. I'm still working through those.
Right.
When I'm losing, I'm trying not to scale in. So I'm working through that. Thanks.
All right, cool. All right, so this is another one of those. And you see that there was actually a second test. The tail of that bar, it's up once, up twice, and 2 failures to go up, and then we're going down.
Hey, Mr. Ashari?
Yeah.
Is 38 a perfect test for the
38.
38?
Perfect test of 30. Yeah, it is.
Yeah,
It
you
looks
said
like.
okay.
So that low is 36 even. That high is 36 even. So yeah, it's a perfect.
So it's a sign of strength, even though there was like
Mhm.
a 4-bar or a 5-bar bull microchannel, but 38
Yeah,
close, that would be a sign of strength.
yeah. The problem.
Ali,
Yeah, sir, go ahead.
on 38 and a test of 30. So 38 is a test of 50% of that breakout.
Several
So,
things. That's one of them.
okay.
So
And I think that's a common thing. I mean, if you took the lower breakout, I guess that's always a good trade.
so it fell short of 50%. I mean, depending on how this is the correct way because this is all going down. So the top of the spike is 27 high. But if you take the top of a spike as this bar, then it is a 50% test.
Yeah.
It's several things. It's really test of the breakout point, which is 24 low, really. But a lot of people, I mean, most people will see 25 low. Most people will see 25 low as the breakout point, and that is correct, I think. Only, I think, very advanced traders recognize 30 for what it is worth and why this is actually a perfect test of 30 as well.
So would you be better at aiming for the breakout point, either like 25 or 30, or just picking a 50% target around that target, the
Yeah,
short?
I honestly don't like 50% or any percentage point because I think everything is relative to what happened. And those arbitrary numbers are just, um,
Arbitrary.
yeah, they are overgeneralizations to prevent really thinking. Because thinking is a hard thing. It uses a lot of glucose, and most people do not like to think. So they like to have, easier things, reference points to alleviate thinking. But if you can think and you find it fun and exciting, then you don't need any percentages. You
So
you
so if
would
I'm
still see them, but you don't need them.
so if I'm trying to be systematic and not think
Mhm.
as much, so would you want to aim for a strong bar in that case, or what would you? I mean, if you're looking at a pullback like that,
Right.
where would you
So
aim?
so let me ask you this. What is the dominant behavior in trading ranges for strong trend bars?
The dominant behavior?
Yeah. You see yeah, failure. Okay, so most big bars, most big trend bars in a trading range environment fail. So big bar reverses, big bar reverses, big bar reverses, big bar down reverses, big bar up reverses. So the dominant behavior is a reversal for a big bar until there is not. So if there was a big bar, here's a big bar. It was supposed to reverse. It didn't. Got follow through. So put a flag on the low of that bar. That bar is important. See what I mean?
But if you go back and study
Mhm.
the bar 29 and 30, and if you look at that formation of a bar that reverses like that,
Okay.
and then you have some length to that, and you
Mhm.
go back and you count where that looks like a strong breakout and a first leg, you
Right.
can get 80 to 90% if you just go first and second leg. You can take that, you can scalp in at half of that and you can get to the bottom of it. So,
Absolutely. I totally agree with you.
and you
Uh,
scale in at the top and you're like, literally, you're 90% on that trade just because that's a good looking bar.
yeah.
Just those two.
Yeah. Also, I mean, you can also say that this was a pullback on a lower time frame, 31. So spike, pullback, one more leg down. Market usually comes back to the area of the first pullback.
Yeah.
It just happens that both of them are the same price.
Well, and
Uh,
it's getting a second. It's getting a second. It'll get a second leg. You know that. So
yeah,
where do you enter in? So
yeah. The important thing is, you know, as I said, you would still see the percentages. How can you not see it as a trader? You know, a trader's eye is trained to see ratios and relationships. So you would definitely see percentages. So this is like you know, almost a 25% pullback from the entire range or 30% pullback, which is good for trend resumption, versus a 75% pullback, which is good for expecting now trading range is more likely. You would definitely see all of those percentages. But the point is, you know, identifying bars or price structures that do something that is unexpected to happen. And then remember what that bar was. And now when the market is reversing, and it's reversing rather strongly, like here, knowing that this is going to test what, and what's the reason for that test, and what failed. And those things then come together to give you that, you know, holistic, a big picture vision that a competent trader has, and allows them to be really synchronizing very closely with the market, have small drawdowns, have fun time trading. Yeah, but you know, you're correct too. From a systematic point of view, big breakouts like this usually have more than 80% chance of a second leg that's tradable after the first pullback. 100% correct. All right, so for Tuesday, now we have a big wedge. All of the Monday sell-off as the first leg, big pullback, second leg down, big pullback, third leg down, and it also looks good. It looks good because the trend line is establishing, the trend channel line is establishing, and the range is compressing with a bit of, you know, parabolic sort of tendencies here towards the last leg. And then the last leg is also a parabolic wedge. So down, pause, down, pause, down. That's ideal. Big wedge. Inside legs are wedges. Last leg is a wedge, the parabolic wedge. But more importantly, we're getting good buying pressure. Good buying pressure. That's important. Versus, I mean, compare that to this one. Not so much buying pressure. But when you get buying pressure and they produce legs that have very good bull bars in them, they produce micro gaps, strong closes, all of those 10 plus 2 factors, then the wedge has a higher probability of reversing. What I want to emphasize here really is that just for the nth time, can't say this really enough, that wedges have two major classifications: with market regime or against market regime. Okay? Now, probability of tradable correction is the E. It's lower here, it's higher there. So really, as far as, you know, classifications go for wedges, you always want to trade wedges that are against the dominant environment. Wedge flags, basically, rather than wedge channels. So another name for this is a wedge channel. This is a wedge flag because it's against the environment. Okay. You want to trade these. In your list of priorities, this has the highest priority. Because, you know, according to my research, at least, these are about 60% chance of success. These are greater than 80% chance of success. So pick your poison. You know, if you want to trade these ones, you have many more losing trades, and then missed opportunities to trade in that direction, which is what you should be doing. Monday and this day are Tuesday are great examples. Wedge channel, not a flag. Wedge channel. I mean, every channel is a flag because it's a leg in a trading range, should reverse. But the reason I'm emphasizing this in this way is for you to remember that a wedge channel or a channel is still in the direction of the momentum, but the flag is in the opposite direction. So hopefully it will help you remember when you're trading and you might be stressed. But wedge channel more down. Okay.
Yeah, go ahead.
Yeah. Wedge flag, even though it is strong, this is against the environment. Environment is a bear environment still. More likely to go down. Yeah, go ahead.
So is it, if it's a wedge channel and it's the market regime, is it more likely for it to go sideways rather than the opposite direction for the correction?
Yeah, or fail. Like this, all of those wedges failed the day before. So these are the approximate probabilities, and this is like the general CE, but then you take this and customize it based on the other information the chart is providing. Now there is a sort of like a third classification, and that is with respect to wedge channels. So if you take the wedge channel, I should have, so let me just modify this a little bit. So take all of that and move down. All right, so there's a sub-classification here, which is wedge channel with strong opposite momentum. Okay, if you get one of these, this is the CE is actually quite good. So it is around 70 to 75%. All right. We need this classification because we have to be able to recognize them. And this is that. So this is still a wedge, bear wedge in a bear market, but it is getting tremendous buying pressure. So if you see one of these, then the probability is not 60%. The probability is 70-75%. This is still not 80%, but it is not 60% either. So when you get the good buy signal bar, even though it is an inside bar 50 here, or bar 50, this bar has more than 70% chance of success. It's one of those trades that sets up maybe once or twice a day, and you don't want to be missing them. Okay, so that's a buy the close bar. And usually one more scaling. Buy the close, this is a very tight leg, might go down a little bit more and then reverse, but that is a 70% trade, especially if you can use a wider stop. All right, so that was the interesting point about Tuesday. In addition to everything that I said about the higher time frame, if you don't recognize any of that, at least understanding that this is a wedge that's getting a lot of buying pressure, and it is probably the channel phase of that. So all of that tight channel, spike on a higher time frame. Now we're getting a channel here that's wider, so that higher time frame is getting two-sided trading too, and then a decent buy signal bar. Very unique trade. It's bar 50 here, say, and big leg up. So the day is overall a bear trend day, trading range day with bearishness in it for the first half of the day. And as I mentioned on those end of day charts, people were selling the EMA of 45-minute chart, which roughly corresponds to this 200 bar EMA here. Bears were going to sell that EMA. They're going to do it time after time after time until they lose. So just because we are there doesn't mean we're going to go higher. That's one thing. The other thing is everybody who got trapped buying above that bar, so we're testing it for the first time. And then finally, you get a day that completely reverses the range. Now it is an expanding triangle, high, low, low, high, new high. It usually goes sideways, not up. The ones that go up happen several times a year, but you know, the probability of seeing one, it's like, you know, 1 in 100 chance. So 1% chance for this to go up. 1 to 5%, because 1% for trading is actually a very, very low percentage. So it's probably something like 5% chance for this to double that range. So buying here is low probability. But selling is also low probability because there's no selling pressure in this. So you have to wait for something a bit more, and that's second entry short. So 69 is again similar probability as 50, but 66 is not. So that's a good, you know, stop or market entry short. So the day before sold off here in a wedge with a very good buy signal bar towards the end of the day. And this is a wedge channel now. Sorry, a wedge flag now rather than a channel. Why? Because the dominant feature was this, and the higher time frame is in breakout mode with potentially being always in long already. We go back to the daily chart for you to see. That was that day. That was Tuesday. Sorry, that was that? Let's see. So 12th. Yeah, so 12th was this. This is that day. This is the prior day, 11th. So we went from the low of 11 to over the high, and we have a low one short late in that channel. There are usually buyers here. So market is probably always in long by context, but we don't see the momentum part yet. Just the context is bad for selling, so it's good for buying. And if it is in that kind of an environment and you're getting this is probably a wedge flag rather than a channel. So it should go up. But the problem is by the time the market opens and it is 64% gap up open, we're already at the prices that we found resistance. So we cannot buy bar 1, we cannot buy bar 2, we cannot even buy below them because tight trading range far above the moving average is a low probability trade. You usually expect these tight trading ranges, even though they're just 2 bars, to bring the price back to the moving average rather than throw it away. So they're actually do nothing bars until you get breakout and follow through. Then there's a sell, point of clarity. So you're going to get a pullback and sell above, expecting more down. That's a low probability buy. So it's a sell, same as this one, same as this one. But then selling 18 and 19 are low probability as well. Maybe not so much 18, but selling 19 is low probability for the same reasons that we talked about all the session. Now you have 2 legs down. This is a big high 2 based on the entire thing. So we have a big breakout, went above the prior swing point, new low. We went above it, so market is in a trading range. And we have a 2-legged correction. So possible high 2 compared to this. 21, risky. 22, much better. And best entry is here, limit order. Expecting sideways to up. Don't forget the gap was up and the first bar was a follow-through bar. Not a great follow-through bar, but minimal follow-through. So this is all bullish towards the entire day structure. And then we get this much selling. So now the bullishness is erased. And we know the bearishness is not great because of the context. And we get, 5 or 6 bull bars. So bears are failing. It's not going to be a bull trend because of that. It's not going to be a bear trend because of this and the gap. So we remained with a trading range day. Became a trading range day. But this provided a lot of buying here, which means probably buyers at the lower prices too. Still, from that higher time frame point of view, there are sellers above the high of the prior bar. This is a very prolonged macro channel, but the test there is likely. And then, as I said before and wrote on that end of day chart, 2 bars, one of them is strong at least, you usually get one more bear bar. So that this is expected, which means intraday for Wednesday, late day, because initially you have this and you have the effect of that. But late day, Wednesday to Thursday, we should go down to produce that one more bear bar that's necessary to balance out the pattern on the daily chart. Which means when it is going up, that up is not all that great. At some point, it's going to exhaust itself and reverse. I thought the first indication was these 2 bars. So we already know the market's in a trading range when you get that near the top of the range. So it's not probably going to go much higher. And then this changed everything down to 54. So all of this is now probably a pullback that tested above the swing point. So you expect a trading range. If you expect a trading range, the leg down should reverse up. But if it doesn't, like here, it's one of those breakout mode situations that produce the lower probability event. So now you should be really interested to see what the test looks like. So down, pause, down, pause, down, pause, down, reversal bar. Market should go above these bars and then go a lot higher, test up there. But if it doesn't, then this area is going to produce resistance. So all of this very strong move up to there is still low probability. Do you see the similarity between these 2 structures, all of this, and then a test? So let me do this because I really want you to see this. This is very, very educational. Okay, so let's keep that and then look at this. Okay, so I'm going to bring it over. Okay, now you can see both of them. Eerily similar, right? But, you know, from a time point of view, this is much more compressed because the number of bars are smaller. This has lasted 2 days or so. But from a price structure point of view, they're exactly the same. You have a channel that becomes parabolic and you get a very strong bull spike as the first reversal. Channel becomes parabolic, very strong bull reversal spike. Low probability, low probability. Both of them are exactly the same. So same thing here. We expect for Thursday, we expect this to fail because it's a vacuum test of a trap. But you know, wait for the failure. Outside down bar, not great. You see the test. This is the second reason to sell. Big, small, big, sell above the first pullback. You know, however you want to skin the cat, but wait for the market to give you the setup. That's the point. And we get, so this is acting as the spike from the breaking point here. And a channel is getting a lot of buying pressure. Every couple of bars, we are reversing. And every time you have a bear bar, you can buy the bear bars. And it's working. And that's the case, leg in a trading range, looking for support, and it should reverse. But based on our classifications here, this is not a wedge channel with strong opposite momentum. This is a wedge in the direction of a market regime, so a wedge channel. And because of that, the first reversal is probably not going to work all that well for the bulls. It's still a tight channel. And we are still below that 200 bar moving average. So buying 53, okay, if you can scale in. Buying 54 is a little bit aggressive because look at, for example, this one. This could happen still. Buying that bar is risky in its own way because the stop is far below. But at some point you have to buy. So maybe buy that bar, maybe buy the big, small, big, scale into the pullback, look for second leg up. Any one of those techniques, or wait for the pullback to finish and start resuming up and then buy a close of a strong bar that's not climactic. That could be 60. It's a good candidate. Fade the first sell signal bar, 61. Buy and buy lower. Buy below the last strong bull bar if you see a strong macro channel. So that would be buying below 63 for a scalp. See, all of them work. So there's never a rush to enter. There's multiple ways to trade, but wait for the market to show you something. That's the point. So if this is all a breakout and this is low probability to buy here, it should lead to a wedge or parabolic wedge pullback or flag, and then we should get a test down. Look back to see what the market is testing. There was a reason to buy here. Reversal, strong reversal, second one, first one, second one, with follow through, and it failed. That close could be the magnet the market's testing. Don't, just put a limit order to sell there, although it worked. But this is also a very strong approach. So wait for the market to show you something. There's always a better opportunity, 2 to 4, 5 bars later. Here, buying that, selling this bar, all of them are okay. But this also leads to a break of the bear trend line for the nth time. But at least in the recent history, that's the third time. 1, 2, and 3 big ones. And a wedge test of the previous bottom. So double bottom with the second leg being a wedge. That's a good double bottom. Double bottoms with the second leg being a wedge have a higher probability of actually working. And then reversal up, 2 or 3 good bull bars. Too late to buy here unless you can hold overnight. But regardless, it increases the probability for the next day to start what we were anticipating from the beginning of the week, which is test down and then a reversal up. And now it is also testing below the low of that bull bar. So see this line here? That is the low of this bar. So we fell below the low of that low one short, which is where limit order traders on the daily chart are having their limit orders. So they would be buying below that bar, betting that the late low one is going to fail and the market is going to go above that, the high of that bar. That trade is still in progress. We don't have the movement enough to get there yet. But that is the trade. So think about it for a second. If you have that point of view on the higher time frame, and you also happen to be a competent day trader, how would you position your account to take advantage of that trade?
You're buying pullbacks and just all the bear attempts to go down, you're basically buying.
Not necessarily.
When there's like a big bear bar or like two-legged bear moves, you're kind of buying them. You could say, you could fade them.
Not really, no. Because your trade time frame is daily chart. So let's go back to the daily chart and take a quick look. What are the recent bar ranges here? So here from there, 133 points, 118 points. I mean, even this is Globex. So if we switch to day session, we have the same setups, right? So here we have 118, 140, 110 almost, 95, 94. So it's somewhere around 100 points, right? So we have a 100-point range for these bars. And your trade is potentially a 150, 200-point trade because you're buying here. You want to go above the high of that bar. So that is 120, almost 5 points here, and you're buying lower. So you're looking for 130 points, 140 points for that trade. Now look at the ranges of these bars. These are 12, 10, 7, 9, 5, 6. So somewhere around 10 at most. Okay. So when you're catching a 130-point trade, are you worried really about 10 points in there? Probably not. So what you would be doing is you look at the way the market is approaching support, because there is support below that low one short. Here's that low one short. And then you look for decent buy setups that are good, swing setups intraday, to buy them with stop or market orders and hold them for 2 or 3 days. Okay, that will mean you're probably looking at this bar is not, it's a bit early because think about it. If you're buying a limit with limit orders on the daily chart, and that line is the support line that you want to buy below, you don't want to buy a little bit below. You want to buy something that is appropriate to the ranges of that higher time frame below. And if that higher time frame has 100-point average ranges, you want to buy 20 to 50 points below that line, not exactly at that line. Or the other way of saying it is that if you see a good setup there, you really not now doubting that the market's going to drop a lot lower, you should still be able to scale in for about that initial 20 to 50-point target. So what was that range to that eventual bottom? So 37 points from the line itself is 40 points, which is with the range that I set, between 20 to 50 points lower. So you will buy this bar. There's no exit on these because you're positioning yourself for a swing on the higher time frame. These are not good entry bars because this is an inside bar. It's late. The swing point formed here and there's a surprise. So that's probably an ignore. And it's not giving you too much of an advantage because if you're scaling in to position yourself for trade on the daily chart, you don't want to buy 3 points or 5 points lower. You want to buy 15, 20, 30 points lower. So that's not a valid second entry. There's nothing to do here. There's something to do. So it would be buying these two bars, and that magenta line is the cost average of that trade. And then you will hold. Sometimes you have to do it one more time. And these are not profit targets. Your profit target is based on the daily chart. So you are still holding that trade here, expecting that sometime next week we are going to go above that low one and hit the stop there. So that's how you would do it. You would use your day trading knowledge to use this lower time frame chart for an optimized entry to hold for a target on the higher time frame. That is why you're day trading. You're not day trading to stay day traders all your life, because that's really a hard life. But this will give you tremendous tools and skill set to eventually be able to trade higher time frames in a very smart and efficient way. Because if this becomes second nature, you're comfortable intraday trading, you can always take it to the higher time frame, and then instead of sitting at the computer like you're at a job, working every day for 6 or 7 hours. You take a position once a week maybe and hold it for 3-4 days, 1 week, sometimes, depending on the market, 1 month, 2 months. And then that is really great. So I think for everyone, this should be the goal. You shouldn't stay a day trader for the rest of your life, unless you really enjoy it. If you enjoy it, that's a different story. But if you are here to make money, then consider day trading as your SEAL team qualification. What do they call it? Hell Week?
Yeah, Hell Week.
Yeah, so this is equal to that. You're really drilling yourself to become really good traders. But to have a lifestyle and to have a life, you don't want to be at the computer every single day of your life for the rest of your life. But you want to use the computer and your skill set smartly to be able to, trade a few times a month, but then capture, big enough profits that are meaningful. Unless you enjoy day trading, that is different.
Ali, can I ask a question about this part of the chart?
Yeah, sure. Go ahead.
I've relied in the past, obviously, I'm fairly new to the group, but I've relied on the past to what Al calls MA gap bars. So if we look at the bottom of Thursday, we see the first sort of bars that bulls are getting above there.
57, for instance.
But referring back to what you said earlier on about the EMA effectively just being a guidance, an indicator, how would you describe that same sort of, because it seems to be quite reliable, what is the price action version of that, if that makes sense?
Right. So here's the price action version of it. I mean, we use EMA as a tool, okay? It doesn't mean it's entirely useless. It's just, I was emphasizing the fact that you can actually trade without an EMA. So if you can trade without an EMA, it means there are some other forces in play that are actually completely useful. So the idea is this: you have a bear trend that's producing a trend line. And this is the general behavior. Every time you're at that trend line, you get to a new low, which is the theory behind channels. But that trend line is intact. There is a first principle, one of the first principles of market behavior that says the first attempt fails. Okay, the first attempt fails, or first attempts fail. And breaking a trend line for the very first time, that is the first attempt. So this is the first break of the bear trend line. If it fails, so this should fail. What does the failure mean in the case of the bear trend? Trend resumption, press down, okay? So it should fail and should go back down. Now, the back down part is the interesting part because there are 3 options here. It will typically create either a higher low, a double bottom, or a lower low. These 3 options. And then it, 40% of the time it leads to a MTR, major trend reversal. But this is the EMA, this is the gap, okay? This area is similar to the gap that you're talking about. Now, if you review the literature that we have on systematic trading, you will see that quants and system designers, they usually summarize things into mathematical algorithms because it is very hard for them to code the stuff that we're talking about. To find a trend line, for example, that is valid is actually a very difficult programming task. But the good surrogate for it is a moving average. So they substitute this trend line. Okay, so they take this and they use EMA instead. Okay, so the EMA basically is summarizing the trend line of the bear or bull trend. Now, how do you say the trend line is broken? You need a bar that's completely above, and that is the moving average gap bar. Okay, so at this point, you have a bar that's completely above, and that bar is the MAG, moving average gap bar. But what it really is saying is the basic behavior of a market transition from a trend to a trading range. You need a trend line break, you need a test, and then you need a reversal setup, which is what we have here. We need a trend line break. You see the bear moving average, the moving average was bearish and it was intact up to this point. Now we've broken it. We have a test, it forms a higher low. So this is a higher low major trend reversal now. Now look at the opposite. Moving average gap bar, very first bar. Price is above the moving average, so this is functioning as support. It leads to a second moving average gap bar at a lower price, and then the market went to a new high. So this high, I said one of these options are possible. In the case of, this was in the case of a bear. In the case of a bull, the three options are a lower high, double top, and higher high in the same order. Okay? So this was a higher high major trend reversal now. Will it work? Who knows? Not really, because major trend reversals have only about 40% chance of success. So most of the time you're going to end up with, break even, small loss. And sorry, I didn't say it correctly. Mind is tired. So MTRs have a 40% chance of success. So 60% of the time, you're going to get a break even or a small loss. And 40% of the time, you're going to get a big win. Which means if you're taking MTRs and you want to realize those probabilities, you are really trading for a swing. You should hold them long enough to get that swing. Because the setup at the inception of the setup is a low probability setup in most cases. Look at this bar. That's not a very good signal bar. This bar is an inside bar. So there's always something wrong with them. But if you buy it, you're holding for a swing. If you hold for a swing, it pays you, I don't know, 10 times, 5 times more than what you risked. And that's how the math works. But the caveat is holding it long enough to get the swing. Same as this one, same as this one. So at the time, this was a double top sort of major trend reversal setup, 70, but small win, not a big win. 78 is a higher high major trend reversal. Good signal bar, but end of day. So if you sell it, you have to hold for over the weekend and probably the next day to hopefully get a move back down here.
That makes perfect sense. Thanks.
Sure,
Yeah,
no problem.
great.
Yep. All right, I just happened to see the time. As it is with my classes, we usually go over time. So, any questions?
Yeah, Mr. Asher. Yeah, I just have one question.
Yep.
So for the quant's way of analyzing if it's the regime, that's the 200 EMA to kind of classify if the wedges are wedge channels or wedge flags.
They want 3 components to agree in the correct order. So they want the price to be above the short-term moving average, and they want the short-term moving average to be above the longer-term moving average. and then they will
Okay.
say market has changed the regime to a bull regime. And if it is bearish, they want the price to be below the fast moving average and the fast moving average to be below the slow moving average.
Okay. So then all the wedges would be wedge channels basically, and they would be classified like that when
Correct.
it's
Yeah.
lined up like that. Okay. Thank you so much.
Sure, no problem. All right, great. So
This
another
is so
another
good.
one
Yeah,
in the
I learned so much. Thank you.
Sure, you're very welcome.
Thanks, Ali. Good to see you.
Thanks,
Thank
Ellie.
Good
you.
to see you. Take care.
Thank
Have a
you
good
very
rest
much.
of your weekend.
Thanks, Sally.
And I'm
Thank
going to
you.
see you next week. Oh, by the
Thank
way,
you.
before we go, so let me stop recording here.